Hi friends, in continuation with the last three parts related to Rocket Revision CA Final May 24 exam, now we are moving on to part 4, and in this part 4 we are going to complete the balance portion in GST. So starting with segment 11, that is invoice, debit notes and credit notes. So in this invoice, debit notes and credit notes, we are going to cover section 31, which is talking about tax invoice, in that a part which is already discussed in time of supply chapter, and then section 32, prohibition from unauthorized collection of tax, and section 33, the tax component to be shown separately in invoice, and section 34, debit notes and credit notes. So in that section 31, subsection 1, so 2 and then 4, 5, 6, 7, everything we have seen. Subsection 3 is only pending. So tax invoice, who will be giving tax invoice? Tax invoice is given by a person, registered person, who is making taxable supply of goods or services. And generally, who will be giving tax invoice to whom? Supplier will be giving tax invoice to the recipient. But in case when the supply is covered under RCM and the supplier is unregistered, so then recipient will be giving the tax invoice to the supplier. So generally, if the supplier is registered, supplier will be giving tax invoice to the recipient. But if the supplier is unregistered and the transaction is covered under RCM, so recipient will be giving tax invoice to the supplier. And what is the time limit? Already we have seen. So multiple provisions related to the due date of invoice. So this is given in time of supply chapter. So in time of supply chapter, we have completed the discussion related to this. Okay. So then we are moving on to bill of supply. So who will be giving bill of supply? Bill of supply is given by a person, registered person, who is making exempted supply, or a person opting for composition scheme, because a person opting for composition scheme should not recover the GST from the recipient. So therefore the name of the document will be bill of supply. Registered person supplying exempted goods or services, or a person opting for composition scheme. Generally, bill of supply is given by the supplier to recipient only, and the time limit for bill of supply is same as the time limit for tax invoice. Then there is something called as invoice come bill of supply. So invoice come bill of supply is whenever the registered person is making supply to an unregistered person, B2C. The transaction is B2C, and that particular transaction covers both taxable supplies and exempted supplies. So then there will be a single document called as tax invoice come bill of supply that will be given. Registered person supplying taxable as well as exempted goods to an unregistered person. Remember, it's a B2C. And again, who will be giving? Supplier will be giving. Time limits as specified. So that is the same time limit what we have seen for the purpose of tax invoice. The same is applicable for bill of supply as well as single invoice come bill of supply. And then there is one relaxation in case of low value supplies. What is a low value supply? Less than 200 is known as low value supply. It's not less than or equals to 200, it is less than 200. So it's a low value supply. Both tax invoice as well as bill of supply is not required. In which case, three conditions. Condition number 1, it should be a B2C supply, means supply to an unregistered person. Number 2, the recipient do not require tax invoice. Number 3, a consolidated invoice should be generated at the end of the day. So if all these three conditions are satisfied, so in case of low value supplies, tax invoice as well as bill of supply is not required. When? Condition number 1, if the recipient is unregistered, B2C, and the recipient do not require tax invoice, and a consolidated invoice or bill of supply should be generated at the end of the day in order to know the accounting purpose. So this is not for any other purpose. So only for accounting purpose, at the end of the day we need to generate that consolidated invoice. However, this provision is not applicable in case of multiplex cinema theatre. So in case of entry to cinema theatre, even if the value of supply is less than 200 rupees, but definitely invoice is required. And what will be taken as an invoice in that case? So the e-ticket which will be given by the cinema theatre, the multiplex cinema theatre, to the customer or to the person who is coming to the movie will be coming under invoice in that case. So in case of multiplex theatres, an invoice, e-ticket deemed as invoice to be issued even if the value of supply is less than 200. Then there is something called as debit note and credit note, which is given in section 34. So when the debit note will be given, whenever there is an increase in the invoice value, so recipient will be showing a debit balance in the supplier books. Always debit note or credit note will be given by supplier to recipient. Recipient shows a debit balance in the supplier books. When the recipient balance increases, so then the name of the document will be debit note. So when it will increase, suppose if the recipient has charged a lesser amount in the invoice, and if there is any additional amount collected, so then the debit note will be given. Or if the recipient is collecting a lesser tax, in order to collect the more tax, so then the debit note will be given. There is no time limit for issuance of debit note. Because of debit note, what will happen? The supplier liability will increase, and based on the debit note, can the recipient take ITC? Yes, recipient can take ITC with respect to that. Then the credit note. Credit note will be given by supplier to recipient. So both debit notes and credit notes will be given by supplier to recipient. In case of debit note, there is no time limit, but in case of credit note, there is a time limit. What is the time limit for issuance of credit note? 30th November of the succeeding financial year or date of filing annual return, whichever is earlier. So for 5 cases, cases the time limit will be same, that is the time limit for availment of ITC, time limit for issuance of credit note, time limit for rectification of GSTR1, time limit for rectification of GSTR3B, and time limit for rectification of GSTR8. So credit note will be given by supplier to recipient whenever there is a decrease in the invoice value. Suppose if the supplier has charged more value and if he is giving a reduction in the value, so then in that case credit note will be given by supplier to recipient. Or suppose if the extra tax is being collected from the recipient, so in order to reduce the tax, for example 18% is collected instead of 12%, so to give the 6%, so they will be giving a credit note. Also in case of sales returns, a credit note will be given. Also in case of deficiency in the quality, also credit note will be given. But remember, credit note cannot be issued in case of bad debts. Then next we have revised tax invoice. Revised tax invoice will arise in a situation when there is a person who is liable to get registered, and from the date he is liable to get registered till the date of certificate of registration. So during that period he will be making outward supplies and he need to pay GST on that outward supplies, but he cannot recover the GST as and when supply takes place. That is between which date to which date? Between the date he is liable to get registered and between the before the date of registration certificate, because only when he get the registration certificate he can charge GST to the customer. Until that point of time on the outward supplies he need to pay GST to government, but he cannot recover the GST from the customer, so he can give the revised tax invoice after the registration certificate within 1 month. So remember, the time limit for issuance of revised tax invoice is within 1 month from the date of certificate of registration. And here one more point is that only if the application for registration is made within 30 days from the date the person is liable to get registered, because in the revised tax invoice they use the word effective date of registration. So what is the effective date of registration? If a person makes application for registration within 30 days from the date he is liable to get registered, the date on which he is liable to get registered is the effective date of registration. If the application is not made within 30 days from the date he is liable to get registered, the date on which he get the registration certificate is the effective date of registration. Suppose if he makes application within 30 days, so effective date of registration is the date he is liable. So from that date till the date of certificate of registration, whatever is the outward supplies, with respect to the outward supplies, whatever GST that has not been recovered from the customer can be recovered by giving a revised tax invoice. However, the application is not made within 30 days, the effective date of registration itself is the registration certificate date, and due to that reason revised tax invoice cannot be issued. But even in that case, from the date he is liable to get registered till the date he is getting registration certificate, he need to pay GST on his outward supplies, and he need to include those details in the first return that he will be filing immediately after registration. So the liability will be payable, but he cannot give the revised tax invoice. And the revised tax invoice, here it is not shall, the words used is may. So because of this reason only, so therefore the supplier may not be able to recover the GST thereafter. So that's the reason why revised tax invoice is not mandatory. It is up to the recipient and the supplier based on the contractual terms. So here 2 points: effective date of registration, and then revised tax invoice cannot be issued if application for registration is not made within 30 days from the date on which liability to pay GST arises. Then next, receipt voucher. Receipt voucher will be given by the supplier to recipient when immediately as and when the advance is being collected. What is called as advance? Any amount that is received before the date of invoice is known as advance. So suppose if the person is collecting the advance, supplier is collecting the advance, the supplier has to give one document to the recipient to establish the proof that the supplier is giving, has taken the advance. So the supplier has to give one document to establish the proof, and the document name is known as receipt voucher. So receipt voucher will be given by whom to whom? Supplier to recipient will be given, and receipt voucher may not be required if the amount is collected after preparation of the invoice, but definitely receipt voucher should be given, shall be given before the date if the invoice is given and the payment is collected. So whenever advance is received by the supplier from the recipient, it is required only if the payment is received before issuance of invoice, and who will be giving? Supplier, and no time limit, so immediately upon advance. And there is something called as payment voucher. Payment voucher will be given by recipient to supplier in case the transaction is covered under RCM, whether the supplier is registered or not registered. So the payment voucher will be given by the recipient to the supplier. So but invoice will be given by recipient to supplier only when the supplier is unregistered and the transaction is covered under RCM. Payment voucher will be coming under situation only when it is RCM, and the recipient will be giving the payment voucher to the supplier to prove that he has made the payment to the supplier. And this payment voucher, immediately as and when the payment is made to the supplier, it has to be given, and here it is given by recipient to supplier. And there is something called as refund voucher. So refund voucher arises in a situation whenever there is some advance which is collected from the recipient and the supplier has given a receipt voucher and the advance is returned. So the supply is cancelled and the advance is returned. In that case, as the amount is refunded along with GST, supplier will be giving a refund voucher to the recipient. But suppose if it is services on the basis of advance, GST is already paid. So because in case of advances, GST is payable with respect to services, so covered under FCM. So in that case already GST is paid, so whenever the amount is refunded, the supplier can get the refund from the government under excess payment of tax by filing RFD1. So refund of advance received and invoice is not yet generated, and the supplier will be giving it to the recipient when? Immediately upon refund. If the amount is refunded after issuance of tax invoice, say the tax invoice is issued and thereafter the supply is cancelled and the amount is refunded, what is the name of the document? Credit note. Supplier will be giving a credit note to the recipient because invoice is already generated. So then a credit note shall be issued by the supplier to the recipient. So but again, credit note wherever it is used, when you are writing, you use the word may. Okay, so but in this case can be issued. Okay, that is the meaning of this word, but generally the correct word that you need to use is credit note may be issued, because there is an alternative to the credit note also. So instead of giving the credit note, there is an alternative. So due to that, supplier can go for refund also. Due to that reason, whenever you are writing the words in the law exam, you use the word may issue a credit note. So then delivery challan. Who will be giving delivery challan to whom? Supplier will be giving delivery challan to recipient whenever there is a transaction that involves movement of goods but it is not a supply. Suppose if it is a supply, anyhow tax invoice is given, it is not a supply but there is a movement of goods. Goods sent on job work or sale on approval or on return basis, or goods sent from head office to branch office within the same state for which separate registration is not obtained, or I don't know what is the quantity to be sold at the time of removal. So in these cases, so supplier will be giving a delivery challan, because this movement of goods should accompany delivery challan. Even e-way bill is also required in this case. So they have not given the time limit, so as and when the goods are moved, the delivery challan is required. Whether recipient details to be mentioned in the invoice, basically if it is a B2B transaction, that is sale to a registered person, definitely recipient details should be mentioned in the tax invoice, no doubt about that. So B2B recipient details should be mentioned, name, address and GSTN of the recipient. But what if it is a B2C transaction? If the value exceeds 50,000 rupees, if the value exceeds or more than or equal to 50,000 rupees, greater than or equal to 50,000 rupees, even though it is B2C, we need to enter the recipient details, that is name, address of the recipient, including address of the delivery with state code, etc. Whereas if it is a B2C transaction and the amount does not, like less than 50,000, not does not exceed 50,000, less than 50,000, then generally recipient details not required. Only if recipient is asking, we need to give the recipient details. However, in case of services through e-commerce operator, OIDR services and online money gaming, so in these three cases definitely the name of the recipient should be mentioned. Okay, so but not necessarily the name of the recipient, it is the name of the state of recipient that should be mentioned. So you need to remember it in 3 points. That is, if it is a B2B transaction, always recipient details to be mentioned, name, address and GSTN of the recipient. If it is a B2C transaction, B2B, okay, B2C transaction, if it is greater than or equals to 50,000 rupees, then also recipient details to be mentioned. If it is less than 50,000 B2C transaction, then in that case OIDR services through e-commerce operator, or in case of online money gaming, state of the recipient to be mentioned. In other cases, only if the recipient requests, we need to mention, otherwise not required. Then the next area that we have is invoice in special cases. Generally, what is the time limit for issuance of invoice in case of services? In case of banking sector or insurance sector, the time limit is 45 days from the date of completion, whereas in all other cases, the time limit is 30 days from the date of completion. Whereas if the transaction is between distinct person, so that too between insurance companies or banking or telecom operators, only in 3 cases. So insurance companies, banking companies or telecom operator, transaction between distinct person, one branch to another branch. So they don't have to raise invoices within 45 days or 30 days as the case may be, but at the end of the quarter, before expiry of the quarter, if they raise invoices, that will be sufficient. So quarterly they can raise. Also in case of banking companies, there is an additional advantage also for them, that is they can make a consolidated invoice at the end of the month. So monthly also they can make a consolidated invoice, rather than, that is what credit card statement, rather than giving the invoice immediately as and when you use the credit card. So they will accumulate all those transactions and at the end of the month they will be preparing a credit card statement. So that facility is there. Then GST implications on debit note and credit note. So who will be giving debit note or credit note to whom? Supplier will be giving it to the recipient. So when the debit note will be given, invoice value increases debit note, invoice value decreases credit note. And debit note don't have any time limit, credit note is having a time limit. And what is the consequence of this? Because of the debit note, the liability of the supplier will be increased, and even recipient can take the ITC with respect to that. But because of the credit note, what will happen? The liability of the supplier gets reduced reduced and the recipient has to reverse the ITC. Suppose if the recipient don't have that much balance in ITC, then his liability will increase, and the supplier has to report the debit notes and credit notes in GSTR1 and GSTR3B, whereas the recipient has to just reverse the ITC or avail the ITC in his GSTR3B. And whatever data of debit notes and credit notes that is furnished by the supplier in GSTR1 will be reflected to the recipient in GSTR2B, and accordingly the recipient can take the adjustments related to this. Then this is one special scenario, like connecting all other documents and what are the options available to the supplier. So suppose if the supplier has collected the money before the date of invoice, so what is the name of the document? Supplier shall issue a receipt voucher to the recipient, and if it is goods, GST not payable on advance, whereas in case of services, GST will be payable on advance. Suppose if the payment is collected after preparation of the invoice, the supplier may issue a receipt voucher to the recipient. It's not compulsory but optional. Suppose if the supplier wanted to give, he can give. Supplier may issue a receipt voucher to the recipient, and based on the invoice, GST is already payable because the time of supply gets attracted. So therefore payment of GST is relevant here. So now what happens here is that suppose before the date of invoice, if the amount is refunded, what will happen? Before the date of invoice, if the amount is refunded, we need to check whether the supplier has refunded the entire amount including the GST. If the supplier has refunded entire amount including the GST, in case of goods, no problem because anyhow GST is not paid, whereas in case of services, already GST paid based on advance. So in that case, the supplier can claim the refund of the GST paid under the grounds of refund voucher. So we have a separate option called as refund voucher. Under that we can claim the refund. So say this amount refunded, supplier may issue. It is not mandatory, it is may issue because there is an alternative available due to that reason. Supplier may issue a refund voucher to the recipient. On goods, no refund because on goods they have not paid any GST, so therefore no refund. Whereas in case of services, as they have paid GST, so they need to claim the refund. So refund on account of refund voucher. Whereas suppose if the supplier has not returned the full amount, for example 1 lakh plus 12,000. So generally whenever we do the marriage hall booking, so it so happens that we will book the marriage hall and pay 1 lakh rupees as the advance along with GST, say 18%, that is 18,000. Thereafter when the booking is cancelled, now the marriage hall person may not refund us 1 lakh 18,000. He will refund only 1 lakh. That 18,000 he has retained. Now in that case, whatever 18,000 that he has retained, he will not be giving a refund voucher because he has not returned the full amount. Now in that case, so we have already paid 18,000 rupees, that is the recipient has already paid 18,000, and the recipient can claim that 18,000 rupees as the refund. So unregistered recipient also can claim the refund. So there is an option available. So if the supplier has not issued refund voucher, burden of GST on advance is on the recipient, and such recipient, even though unregistered, can claim the refund. That is with respect to this. Then suppose if the amount is refunded after preparation of the invoice. So after preparation of the invoice, if the supply is cancelled and the amount is refunded, again you check whether the entire amount is refunded by the supplier to the recipient. Yes, entire amount is refunded by supplier to recipient. So then in that case, so the supplier is having two options. Either they can go for credit note. Supplier can issue a credit note. So whenever supplier issues a credit note, the advantage is their liability gets reduced immediately. Whereas then also another alternative to the supplier, that is supplier can go for refund also under excess payment of tax. These two options are applicable only if supplier has refunded the entire amount to the recipient. Again here, what if the supplier has not refunded the entire amount to the recipient, only the value has been refunded, whereas the GST is retained by the supplier? In that case, the recipient can claim the refund. Okay, so this note is equally applicable even in this scenario also. So whenever the supplier has not refunded the GST component, the recipient who is having the liability or who is having the burden, so can definitely get the refund even though he is unregistered. Then section 32 says that, so all these points what we have seen so far is related to section 31 subsection 3, and section 32 says that being a unregistered person, you are not supposed to collect GST from the recipient. Also you should not collect GST in excess of the GST that is applicable on the transaction. Suppose if the transaction is taxable at 12%, you should not collect more than 12%. And then GST component should be shown separately in the invoice always. So that's the reason why any invoice, so where they should show separately how much is the value and how much is the GST, like that they should show separately. That's a mandatory provision as per section 33. And 34, that is debit notes and credit notes, already we have seen. Then usually in the invoice we need to mention the HSN with respect to goods. In case of services, SAC should be mentioned. HSN code refers to harmonized system of nomenclature code which is developed by World Customs Organization, and all the GATT countries will be following this particular code. And even GST law also, what they are mandating is that in the tax invoice, against the description we need to give the HSN code for goods, whereas in case of services, SAC code is there. SAC code is developed by Indian government only, and SAC code is a 6-digit number, whereas HSN code is a 8-digit number, whereas in that 8 digits, not entire 8 digits we need to enter. Suppose if the aggregate turnover of the supplier during the previous year does not exceed 5 crores, then with respect to their B2B suppliers, that is supplied to a registered person only, they need to enter HSN, that to 4 digits only they need to enter. Whereas if the aggregate turnover during the previous year exceeds 5 crores, then in that case with respect to B2B suppliers as well as B2C suppliers, so they need to mention 6 digits. So 6 digit needs to be mentioned, that is not entire 8 digits. So whereas for services, it is service accounting code and all the 6 digits needs to be mentioned, and there is no relaxation. Then there are two special concepts called as E-Invoice and dynamic QR code. So basically E-Invoice is a normal invoice. So in E-Invoice we need to understand 3 aspects. Number 1, what is a E-Invoice? Number 2, who is required to give E-Invoice? Number 3, who are not required to give E-Invoice? First, what is E-Invoice? With respect to a normal invoice which is uploaded in the invoice registration portal. So there is a portal called as invoice registration portal. In that invoice registration portal, I will be uploading a normal invoice. And with respect to that normal invoice, if 3 things are obtained from the invoice registration portal, what are those 3 things? Invoice reference number, quick response code, and digital signature. Then that document will be called as a E-Invoice. What are the 3 things that will be obtained? Invoice reference number, quick response code, and digital signature. So this should be obtained from invoice registration portal with respect to a normal invoice. So then it will be called as a E-Invoice. So what is the E-Invoice process? Basically in E-Invoice process, you can see that in page number 110, what will happen is that, so just follow the steps that is involved. Taxpayer will be preparing a normal invoice using his billing software, and thereafter it will be converted into .json file, that is JavaScript object notation. After converting it into .json file, it will be uploaded into the invoice registration portal using the API plugins. And once it is uploaded in the invoice registration portal will do the deduplication check. It will check whether this invoice is already uploaded or not. So after verification, and they will be giving 3 things to this document, that is generate invoice reference number, QR code, and digital signature, and from there it will be pushed to GST system and e-way bill system. In the GST system, automatically GSTR 1 of the seller and GSTR 2B of the buyer gets updated. So therefore this will not lead to any data entry. So if there is a data entry, there could be errors that are possible, but in this case there are no errors possible because the data will be automatically pushed from invoice registration portal to GST portal as well as e-way bill portal. And even buyer can verify the authenticity of these invoices by entering the invoice reference number or QR code, so to know whether it is a genuine invoice or a fake invoice. And there is one very important condition, that is that suppose if there is a supplier who is required to give a E-Invoice, but instead of giving a E-Invoice he gave a normal invoice. In that case, recipient, even though it comes in the recipient's 2B, but recipient cannot take ITC with respect to that. So that is a restriction now. So if a supplier is required to give E-Invoice but issued a normal invoice instead of E-Invoice, then the recipient cannot avail ITC even though such invoice is reflected in 2A or 2B of the recipient. That is an important point. Then there is one amendment here, that is if there is any registered person whose aggregate turnover exceeds greater than or equals to 100 crores, they shall report invoices including debit notes and credit notes in the invoice registration portal within 30 days from the date of invoices. Like this one small amendment they have added. So within 30 days from the date of invoices, they should ensure that all the invoices are uploaded into the invoice registration portal, invoices, debit notes, and credit notes. And to whom these E-Invoices will be applicable? Is it for this 100 crores? No. So E-Invoice is applicable if your aggregate turnover in any previous year from 17-18 exceeds 5 crores. So then itself E-Invoice will be applicable. So aggregate turnover in any previous year from 17-18, if it exceeds 5 crores, that too with respect to B2B supplies only, E-Invoice is required. What if it does not exceed 5 crores? In every financial year we have to see 5 crores per year. So if any financial year it does not exceed 5 crores, then E-Invoice is not required. So that is about the applicability of E-Invoice. To whom E-Invoice is not applicable? So in case of biggest, so there are some people, even though their aggregate turnover during the previous year exceeds 5 crores, but E-Invoice is not applicable in that case. Biggest, B for banking company. Don't write the mnemonic biggest in exam, but just remember this keyword and you write in points 1, 2, 3, 4 like that. So B for banking company, financial institution, NBFC, and then I for insurance company, G for GTA, goods transport agency, another G for government department or local authority, then E for exhibition of film in a multiplex theatre, and S for SEZ unit, not SEZ developer. SEZ developer is required to give E-invoice, but SEZ unit is not required. What is the difference? SEZ developer is the person who developed the SEZ or the infrastructure of the SEZ, whereas SEZ unit is the person who do business inside the SEZ. So SEZ unit is not required to give E-invoice. Then last T, transportation of passengers in any mode, that is railways or airways, etc. So these people, even though their aggregate turnover exceeds 5 crores, they are not required to give E-invoice. Also, they need to give one declaration in the normal invoice that even though our aggregate turnover exceeds this 5 crores, but we are covered under the exclusion list, so we are not required to give E-invoice. Then only the recipient will be aware that the supplier is not required to give E-invoice, because there is a high risk to the recipient that the recipient cannot take ITC if the supplier is not giving E-invoice. That's why this declaration is required. So see this. So that is about this E-invoice. Then what is dynamic QR code? Dynamic QR code will be applicable in case of B2C supplies, and dynamic QR code is simple. Whenever we need to collect the payment by scanning the QR code, that is called as dynamic QR code. So dynamic QR code is prepared by embedding few fields into that. So dynamic QR code is mainly to bring in the digital transactions into the economy or accounted transactions into the economy. But the dynamic QR code is different from the QR code what we have in E-invoice. E-invoice QR code will be generated by the portal, but dynamic QR code will be generated by the registered person using point of sale device, that is a swiping machine which is provided by the banks, or it is based on many apps or websites. There are a lot of ways in which we can generate the dynamic QR code, and in order to generate dynamic QR code, there are 5 fields which needs to be embedded into the dynamic QR code, that is GST of the supplier, which will be static, and UPI ID of the supplier, that is also static, it will not change between invoice to invoice. Bank account and IFSC code of the supplier, that is also static, it will not change. Whereas invoice number and date and invoice amount along with breakup of tax, it will change from invoice to invoice. So entering these 5 fields, if we create a QR code, that is known as dynamic QR code, and there are some exceptions for this dynamic QR code. So first we have seen what is dynamic QR code. Then to whom this dynamic QR code is applicable? In case of B2C supplies, that is supply to an unregistered person, that too if my aggregate turnover in any previous year from 2017-18 exceeds 500 crores. So then only dynamic QR code will be applicable. So for B2C supplies only, and dynamic QR code in the invoice is required. So from this what we can understand, if my aggregate turnover during any previous year from 17-18 it does not exceed 5 crores, so neither E-invoice for B2B supplies nor dynamic QR code for B2C supplies. If it exceeds 5 crores but does not exceed 500 crores, with respect to B2B supplies it will be E-invoice, whereas with respect to B2C supplies dynamic QR code not required. If it exceeds 500 crores in any previous year from 17-18 onwards, then with respect to B2B supplies E-invoice required. With respect to B2C it will be dynamic QR code. Then invoice should be prepared in the prescribed form. What is that prescribed form? INV1, that is using the accounting software or any ERP, we will prepare the invoice. That invoice should be based on a prescribed format, that is form GST INV1. It is optional for a taxpayer whose aggregate turnover during any previous year does not exceed 5 crores. If they want to give invoice, they can still give invoice, and whatever invoice that is generated will be auto populated in the GSTR1 and e-way bill, and physical copy of the invoice is not required in case where E-invoice is applicable. So generally invoices needs to be prepared in triplicate in case of goods, original for buyer and duplicate for transporter and triplicate for assessee, that is supplier. Whereas whenever the E-invoice is made, so then it is not required. Same way service provider is required to give invoice in duplicate, that is original for the recipient, duplicate for the supplier. But when E-invoice is applicable, so the physical copy of the invoice is not required, and QR code can be produced before the proper officer for verification. So during the transportation, the proper officer can stop the vehicle and ask for the invoices. In that case, this QR code can be shown to the proper officer. And types of transaction for which invoice is required, all B2B transactions, whether the outward supply is covered under FCM or RCM. So my outward supply is covered under RCM, so even then in that case, so I have to give the E-invoice. So if whether it is FCM or RCM, for outward supplies E-invoice is applicable. Zero rated supplies and even credit notes and debit notes. Zero rated supplies, so B2B or B2C classification shall not arise, so zero rated always E-invoice is applicable, and then credit notes and debit notes B2B. Then So in case of dynamic QR code, we have some relaxations who is not required to give dynamic QR code. So big toe, you remember big toe, so here it is biggest, E-Invoice, big toe for dynamic QR code. B same, banking company, financial institution, NBFC, and I for same, insurance company, and G for same, GTA. Whereas next we have TOE, T also same, transportation of passengers in any motor vehicle, any mode. And then O for OIDR, supplier located outside India and making supply to non-taxable online recipient in India. E for exhibition of film in a multiplex theatre. So these cases dynamic QR code is not required. And then some more exceptions are there. See this, generally UPI ID of supplier should be embedded into the dynamic QR code, but suppose if the payment is not collected by the supplier but it is collected by the e-commerce operator or any courier agency. In case of Amazon, I am selling through Amazon, wherein so my UPI ID will not be there because Amazon is going to collect. So Amazon's UPI ID should be embedded. So if the payment is collected by e-commerce operator or any other person, the UPI of that e-commerce operator or other person should be mentioned. Then next, bank account and IFSC code of the supplier. So there is an exception not required if the UPI ID is linked with the bank account. So generally UPI ID is linked with the bank account, but in case what will happen is that the banker only is giving the UPI ID. So then in that case UPI ID is connected. Suppose if I am having account in HDFC Bank, HDFC only will give. But if I am having account in IndusInd Bank but Axis Bank is giving UPI ID, then UPI ID is not connected to my bank account. That is the meaning of that. Then invoice number along with the date, there is an exception that usually in case of retail counters, so in the supermarkets they will not be able to generate the invoice number properly due to that reason. So any unique reference number can be followed by them. And whereas in case of invoice amount along with breakup of value and tax, remember only when the payment is collected after preparing the invoice, dynamic QR code is required. Whether the payment, when the payment is collected before the invoice, dynamic QR code not required because the payment is already collected. If the cross reference of that payment is mentioned in the invoice, that will be sufficient. So if part payment is collected before invoice and part payment is collected after invoice, so we need to prepare a dynamic QR code only for the remaining amount, that is remaining part. If the part received before invoice and remaining after invoice, then only the balance due should be mentioned. And exception to mentioning dynamic QR code invoice if the payment is received before at the time of generating invoice and the cross reference of that payment is entered, even if it is cash receipt, the date on which the cash is received is mentioned. So then dynamic QR code not required. One more case also, if the supplier is in India and the recipient is outside India and the place of supply is in India and the payment in convertible foreign exchange, it is not an export of service because place of supply should be outside India, then only it will be called as export of service. As the place of supply is in India, it is not export of service, but the recipient is outside India. So if it is a zero rated supply, definitely invoice required, but it is not a zero rated supply in this case. So then in that case, whether dynamic QR code is required? No, not applicable because the recipient located outside India cannot make the payment by scanning the QR code. So due to that reason, dynamic QR code is not applicable in this case. Then so one important point, that is generally in case of this biggest, so they are not required to give e-invoice with respect to their services. What if they are providing some other services? For example, a banking company, for banking services e-invoice not required. What if they are providing renting of immovable property services? With respect to that renting of immovable property services, whether e-invoice is required? No, it is not about the services, it is about the service providers. So these service providers are not required to give e-invoice even if they do any other transaction also. For that they gave one clarification, whether the exemption for mandatory generation of e-invoice is available for entity as a whole or in respect of certain supplies made by the said entity. So the exemption is available for the entity as a whole. So this point is common for all people, and that is with respect to invoice, debit notes and credit notes. So these are the various points, and then we are moving on to segment 12, that is registration. So in this registration we have total 9 sections. The first 3 sections talk about the legality. See, up to section 21 we have seen in input tax credit chapter. 21 talks about recovery of wrongly distributed ITC, 20 talks about input service distributor, and 19 talks about goods sent on job work, and 18 talks about input tax credit in special cases, and 17 about apportionment of credit and block credit, and 16 conditions for availment of ITC. 15 also we have seen, that is talking about value of supply, and 14 time of supply in case of change in rate, and 13 time of supply in case of services, 12 time of supply in case of goods, and 11 exemptions, 10 composition scheme, 9 liability to pay GST, FCM, RCM, and 8 composite supply, mixed supply, 7 supply. And after this section 30 also we have discussed a few sections, that is 31 which talks about tax invoice, and 32 which talks about prohibition from unauthorized collection of tax, 33 tax component should be shown separately invoice, 34 debit notes and credit notes. So now this this 22 to 30 talks about registration. In the first 3 sections, 22 talks about when a person is required to get registered, 23 exemption from registration, 24 compulsory registration. This is about legality. And 25 procedure for registration, 26 deemed registration, 27 special provision for CTP and NRTP. Then 28, 29, 30 talks about the special cases, 28 amendment to registration, 29 cancellation or suspension of registration, and 30 revocation of cancellation of registration. So in this, first we need to understand section 22. So when a person is required to get registered, so as and when the person's aggregate turnover exceeds the threshold limit, that person is required to get registered. So what is the meaning of aggregate turnover? Aggregate turnover includes taxable supplies, exempted supplies, non-taxable supplies, zero rated supplies, including interstate supplies, and it should be computed on an all India basis. But aggregate turnover do not include inward supply on which GST payable under RCM and taxes. So that particular aggregate turnover, if it exceeds threshold limit, they are liable to get registered. What is the threshold limit? If they are doing business in a single state, we need to check whether that state is in MMTN, Manipur, Mizoram, Tripura, Nagaland. If yes, then the limit will be 10 lakhs for goods or services. Whereas if they are doing business in a single state and that single state is in U stamp, Uttarakhand, Sikkim, Arunachal Pradesh, Meghalaya, then Puducherry. Uttarakhand, Sikkim, Telangana, Arunachal Pradesh, Meghalaya and Puducherry. So in that case the limit will be 20 lakhs. Suppose if it is other states, the limit will be 40 lakhs if they are exclusively engaged in supply of goods, and if they are engaged in supply of both goods and service or services, then the limit will be 20 lakhs. So these are the 3 points that you need to remember. That is, if they are doing business in a single state and that state is in MMTN, Manipur, Mizoram, Tripura, Nagaland, the limit will be 10 lakhs. Suppose if they are doing business in a single state and that single state is in U stamp, Uttarakhand, Sikkim, Telangana, Arunachal Pradesh, Meghalaya, Puducherry, then the limit will be 20 lakhs. Other states exclusively engaged in supply of goods, it will be 40 lakhs. Other cases, that is supply of goods as well as service and supply of service, it will be 20 lakhs. Also remember, if they are exclusively engaged in supply of pan masala, tobacco and tobacco products, ice cream, edible ice, bricks and roofing tiles, the 40 lakhs limit will not be applicable, then the 20 lakhs limit only will be applicable if they are engaged in supply of these goods. So either as a manufacturer or as a supplier. Whereas in case of composition scheme, it is for manufacturer. Manufacturing of these goods cannot be getting composition scheme, but in that list of goods extra aerated waters is there. Whereas in case of registration chapter, we don't have aerated waters, it is only this list of goods. And see these important points, aggregate turnover should be computed on all India basis and not state wise, and the limit of 40 lakhs is applicable only in case of exclusive supply of goods. Now suppose if the person is doing business in more than one state, so what we need to do? Then also remember 3 points. Number 1, if one of the state is a special category state and taxable supplies are made from that state, then it will be 10 lakhs. If supplies are made from multiple states and taxable supplies are made from special category states, then 10 lakhs will be applicable. None of the state is in MMT and U stamp and they are exclusively engaged in supply of goods, 40 lakhs. Otherwise it will be 20 lakhs. None of the state is in MMT and U stamp. All the states should be other states and they are exclusively engaged in supply of goods, 40 lakhs. Other cases it will be 20 lakhs. If supplies are made from multiple states and in those states if U stamp is also one of the state, then 20 lakhs will be the applicable limit. Then the limit of 40 lakhs is not applicable in the following cases: person who is voluntarily getting registered, who are compulsorily required to get registered and making supply of these goods: ice cream, edible ice, pan masala, tobacco and tobacco products, bricks and roofing tiles. So as and when aggregate turnover during a financial year exceed threshold limit, as discussed above, the person is liable to get registered. Whereas section 23 talks about exemption from registration. So in few cases a person is not at all required to get registered. Suppose if they are exclusively engaged in making exempted supplies including non-taxable supplies, or if their outward supplies is fully covered under RCM, or if they are an agriculturist to the extent of cultivation of land, means being an agriculturist they should make supply out of cultivation of land, they should not be engaged in any other activity. So if a person is making both exempted and taxable supplies, then the exemption is not applicable, and if their aggregate turnover exceed threshold limit, they need to register. And there is one relaxation here. Generally a person who is making supply of goods through e-commerce operator is compulsorily required to get registered. Supplier of goods through e-commerce operator is compulsorily required to get registered. But in case the supplier of goods through e-commerce operator is not making any interstate supplies either directly or through e-commerce operator, then he is required to get registered only when his aggregate turnover exceeds threshold limit. But that person is required to obtain a unique enrollment number. So person making supply of goods through e-commerce operator, so they are required to get registered only when aggregate turnover exceeds threshold limit. He shall not make interstate supplies. He shall not make supply through e-commerce operator in another state, means direct interstate supplies or interstate supplies through e-commerce operator, and they need to declare their name, permanent account number, address for validation, and they need to get a unique enrollment number, and as and when their aggregate turnover exceeds threshold limit, their unique enrollment number cease to be valid and they need to get a normal registration. Then so compulsory registration under 22 also there is some compulsory registration, 3 cases. Whenever a person was registered under the earlier indirect tax regime, he should also be registered under the GST law, and if there is any transfer of business, then the transferee should get registered. If there is any amalgamation, merger, demerger, the resulting entity should get registered. But in these 3 cases, what will happen is that they will register, and if their aggregate turnover falls below threshold limit, they can make application for cancellation of registration. Whereas under section 24 there is some compulsory registration. In that case, even if their aggregate turnover falls below threshold limit, they cannot make application for cancellation of registration. So what are those cases? Remember the keyword I creations. I for person making interstate supply of goods, not interstate supply of services, interstate supply of goods, that too other than handicraft. If he is making interstate supply of services or he is making interstate supply of handicrafts, they need to register only when aggregate turnover exceeds threshold limit. And casual taxable person other than handicrafts. Casual taxable person is a person who come from other state to this state and is not having any physical place of business in this state, so they are compulsorily required to get registered, and the registration granted to them will be a temporary registration. But in case if they are coming as a handicraft sellers, in that case they need to register only when aggregate turnover exceeds threshold limit. Then recipient who is liable to pay GST under RCM 9 subsection 3, and e-commerce operator liable to pay GST under 9 subsection 5, that is HATE, housekeeping service, accommodation service in the transportation of passengers and eating food from the restaurant, or e-commerce operator liable to deduct TCS under section 52. So these 2 e-commerce operators are compulsorily required to get registered. Then A, agent making supply of goods or services on behalf of the supplier. Every agent making supply on behalf of the principal, so is required to get compulsorily registered. T for TDS deductor. TCS deductor already covered under e-commerce operator. I for input service distributor. O for online, that is OIDR services, online information database action retrieval services, OIDR supplier located outside India and making supply to non-taxable online recipient. Also remember, online money gaming supplier located outside India is also compulsorily required to get registered. So that point I have given later, so at a different place. But also remember, even online money gaming supplier, located outside India, is also compulsorily required to get registered, is compulsorily required to get registered, okay. So then N for non-resident taxable person. Non-resident taxable person come from the other country to this country and is not having any physical place of business in this country and is engaged in supply of goods or services. So even for them the registration will be a temporary registration, but they need to compulsorily get registered. And supplier of goods through e-commerce operator other than those who are making only intrastate supplies. So these are the cases where they are compulsorily required to get registered, and once they are registered, so even if their turnover falls below threshold limit, so they cannot make application for cancellation of registration. Now here what happens is that, suppose if my outward supplies are covered under RCM, I am exempted from registration, and I have some inward supplies on which I need to pay GST under RCM. So I am compulsorily required to get registered because recipient liable to pay GST under RCM is compulsorily required to get registered. But section 23 overrides section 24. So what happens is that section 23 overrides all the sections. So if a person is exempted from registration, he is not required to get registered, whereas section 24 overrides section 22. Whereas section 24 says that even if my aggregate turnover does not exceed threshold limit, I need to register, but section 23 overrides even section 24 also. Then procedure for registration, which is given in section 25. In that procedure for registration, remember few forms, that is REG 1 to REG 6. REG 1 talks about application for registration. REG 2 acknowledgement. Once you make application for registration, you will get acknowledgement. REG 3, suppose if there is any discrepancy, they will give a notice. REG 4, reply to the notice. REG 5, rejection of application. REG 6, certificate of registration. Now once you make application for registration, what is the time limit for making application for registration? Within 30 days from the date when a person is liable to get registered. Whereas in case of CTP, NRTP, they need to make application for registration at least 5 days before commencement of business. Otherwise, generally 30 days from the date you are liable to get registered. And once you make application for registration, so immediately you will get the acknowledgement. And once the application is made, within 7 working days, either we need to get a notice or we need to get the registration certificate. Suppose if we get the registration certificate, no issue, otherwise we will get a notice, and after notice we need to give reply to the notice in REG 4. So REG 3 to REG 4, 7 working days. Once we make reply to the notice, so within 7 working days from the date we gave a reply, either they need to grant the registration certificate or reject the application within 7 working days. So in all these cases the time limit is 7 working days. Then along with the application for registration we need to give bank details, but we can give the bank details later also after registration. So that point got amended. Previously it was 45 days and now they have changed it to 30 days after registration. So we need to update the bank details within 30 days from the date of registration or date of filing GSTR1, first GSTR1 after registration. So not due date, date of filing GSTR1 or invoice furnishing facility in case of QRMP, whichever is earlier. And this is not applicable in case those who are required to deduct TDS or TCS. So they need to give the bank details at the time of application for registration itself. Suppose if these bank details are not submitted within this time, that is one of the reasons for cancellation of registration. Then Aadhaar authentication is mandatory. So at the time of registration it is not mandatory. So at the time of registration it is optional, but after registration we need to definitely obtain the Aadhaar number and we need to update the Aadhaar, otherwise the registration granted will become invalid. But at the time when we make application for registration, we have two options. Option number 1, either Aadhaar authentication, or option 2, without Aadhaar authentication. In option 1, Aadhaar authentication, what will happen? We will be submitting the part B of the registration application. So once we submit the part B of the registration application, so we will get a Aadhaar enrollment, Aadhaar authentication link. In that Aadhaar authentication link, we need to complete the OTP verification. So that is known as Aadhaar authentication. And after Aadhaar authentication, within 7 working days, registration will be granted. Okay. So therefore there won't be any site verification. But suppose if we have completed the Aadhaar authentication and if the officer is of the opinion that based on risk parameters require site verification, they will be taking it for physical verification. Suppose if the Aadhaar authentication is not completed within 15 days, actually we need to complete the Aadhaar authentication within 15 days from the date we submitted part B, otherwise it is deemed that the application is submitted without Aadhaar authentication. Suppose if the application is submitted without Aadhaar authentication, or the application is submitted with authentication but not completed within 15 days, or application submitted with authentication and authentication completed but the officer requires site verification. In these 3 cases, the registration will be granted only after physical verification of place of business. So this can be tested as a short note question. So what are the 3 cases where physical verification will be done? Number 1, application without Aadhaar authentication. Number 2, application with Aadhaar authentication but authentication not completed within 15 days. Number 3, application with authentication and authentication is completed but the officer requires physical verification. In these 3, based on risk parameters. So in these 3 cases, physical verification will be taken by the proper officer. Only after carrying out the physical verification, registration will be granted. That's why here the time limit will be 30 days, not 7 working days. So in these 3 cases, officer will conduct the physical verification of place of business within 30 days of application. After physical verification only, registration certificate will be granted. Suppose if the registration certificate not granted within 30 days, so then in that case it is deemed to be registered. Now here we have one point, what should be taken as the date of application? The date of authentication only will be taken as the date of application. Suppose if the 15 days you have not completed, now the 30 days will be counted after 15 days. So within 15 days if the authentication is not completed, that 15 days will be taken as the date of application. From there the 30 days will be counted for physical verification. So that is this point. And then applicability of Aadhaar authentication. So few cases Aadhaar authentication is not applicable, few cases it is applicable. So that you remember easily. First, individual, which case it is applicable? If the person so is other than citizen of India, so therefore Aadhaar authentication not applicable. So citizen of India, Aadhaar authentication applicable, not citizen of India, Aadhaar authentication not applicable. In case of HUF, so for Karta only Aadhaar authentication applicable, for other members Aadhaar authentication not applicable. Same way for firm or LLP, authorized or managing partner only Aadhaar authentication, other partners Aadhaar authentication not applicable. Company, body corporate or any other entity, authorized signatory should undergo authentication and other members not required to undergo authentication. Whereas in case of government, all all, that is central government, state government, local authority, statutory body or public sector undertaking. Government and its family members do not require to undergo authentication, and others UIN holder. So total 9 people not required to undergo authentication, that is not a citizen of India, and members other than Karta of HUF, and then partners other than authorized or managing partner, members other than authorized signatory, central government or state government, local authority, statutory body, public sector undertaking, and UIN holder. And even these people are not required to author authentication even after registration is granted, but others, so at the time of registration, suppose if they have not undergone authentication, at a later point of time they should complete the author authentication. There is a concept of deemed registration. First, wherever 30 days point is applicable, there we will see first. So what are the cases where 30 days point is applicable? Number 1, you made application without authentication, so they have to grant registration within 30 days from application. You made application with authentication, but authentication not completed within 15 days. After 15 days, within 30 days they need to grant. And thereafter, third case, you made application with authentication and the officer has taken up, no, you have completed the authentication and the officer has taken up for physical verification, and again within 30 days if they are not granting. In these 3 cases, deemed registration. See here, you have opted for authentication, no, so then within 30 days you have not opted, means within 30 days from application they need to grant registration after physical verification, otherwise deemed registration. Suppose you opted for authentication and not completed within 15 days, then also, so within 30 days after completion of that 15 days, so they will be doing physical verification and they will grant registration, otherwise deemed registration. Or you made application with authentication, completed, but officer has taken up for physical verification based on risk parameters, then also 30 days from application if they are not granting registration after physical verification, then also deemed registration. Normal cases, there is no issue involved. So you make application for registration within 7 working days, neither you got a notice nor you got a registration certificate, then also deemed to be registered. Then suppose you got a notice and after notice you gave a reply, after reply within 7 working days, neither rejection nor certificate of registration, then also deemed registration. So 2 points related to 7 working days and 3 points related to 30 days. So these 5 points deemed registration. Suppose if you get a question, so what are the situations where the registration is deemed to be granted to a registered person? Here deemed registration means they cannot reject the application. It does not mean we get the registration certificate and all. So then next we have time limit for making application for registration. Section 24, CTP NRTP, at least 5 days before commencement of business. In all other cases, within 30 days from the date they are liable to get registered. When are they liable to get registered? If they are covered under 24 compulsory registration, as and when they commence the business, from there within 30 days. Suppose if they are already registered under the earlier law, so within 30 days from 1/7/2017. Whenever there is a transfer of business, within 30 days from the date of transfer. Whenever amalgamation, merger or demerger happens and a new company, resulting entity has been formed, so within 3 days from the date on which the resulting entity, certificate of incorporation is given for the resulting entity. In any other case, within 30 days from the date the person aggregates turnover exceed threshold limit. Then section 26 talks about deemed registration, that is if you are registered under CGST Act, you are deemed to be registered under SGST Act and vice versa. Then 27, special provision for CTP NRTP. Generally CTP NRTP should make application at least 5 days before commencement of business and they need to get a compulsory registration, and the type of registration granted to them will be a temporary registration for a maximum period of 90 days. Number of days that they are requesting for registration or 90 days, whichever is lower. Suppose if they want to continue beyond 90 days, they should make an application and it can be extended for a further period not exceeding 90 days. But in the maximum case, it will be 180 days. So that is the period of registration that will be granted to them. And during the period, they are operating a CTP NRTP. Along with the application, they need to pay the advance tax because they will not have any physical place of business. So they need to deposit the advance tax, and that advance tax will be based on their estimated net tax liability, that is estimated gross liability minus estimated ITC. So they need to deposit the estimated net liability. Suppose if any extension is granted for that extended period, again the additional advance tax needs to be deposited, and this advance tax will be credited to the electronic cash ledger, and if there is any liability that will be set off. If there is no liability, it will be refunded. If there is any excess liability, it will be payable. So this balance we will get as a refund from the cash ledger, which we have already seen in the refunds. Then distinguishing points, if you see between CTP and RTP, is that CTP is a person who occasionally undertakes transaction involving supply of goods or services, or both in the course or furtherance, whether as a principal or agent or any other capacity in the state where he has no fixed place of business. Whereas NRTP, so where in India he is not having any fixed place of business. Both cases they occasionally come and make supply of goods or services. Whereas CTP undertakes the transaction in the course or furtherance of business, NRTP no such requirement. CTP will have a permanent account number, using that they will get the registration, whereas NRTP will not have a permanent account number. So based on the passport, the registration will be obtained. The application for registration for CTP is GST REG1, whereas for NRTP it is REG5. CTP will file the regular returns GSTR1 and GSTR3B, whereas NRTP will file GSTR5. So GSTR1 3B regular returns, the regular time limit, whereas 5 is 13th of the month following every month, or so 20 days, 13th of the month following every month, or 7 days from expiry of registration, whichever is earlier. So that is the time limit for this GSTR5. Then section 28 talks about amendment in registration. So amendment in registration is initially at the time when we submitted any details for registration. If there is any change in those details, then it will be called as amendment in registration. So in case of amendment in registration, if there is a change in detail that leads to change in permanent account number, we will not go for amendment in registration. We will cancel the registration and we need to get the new registration. But get the new registration and transfer the ITC, then cancel the old registration. So whenever there is a change in permanent account number, we need to go for new registration. Amendment registration is there is no change in permanent account number, but there are some changes. That changes can be change in core fields, change in non-core fields. What are the core fields? Change in name, change in address, and change in top management is core field. That will be subject to approval by the proper officer. Whereas any other change, non-core field, that will be automatically approved by the portal, and the effective date of the amendment will be prospective. But if we need a retrospective amendment, so then retrospective amendment in registration is possible only with the order of the commissioner. So what is the procedure for amendment in registration? First we need to make an application for amendment, that is in REG 14. What is the time limit? Within 15 days of the change we need to notify, and once we make this application for amendment, so then it will be forwarded to the proper officer if it is related to change in name, change in address, or change in top management. And if the officer is satisfied, he will grant. Otherwise within 15 working days, so he will give a notice. So within 15 working days, either the officer will grant the amendment order or he will give a notice. Neither notice nor amendment order within 15 working days deemed to be approved. Okay, so now notice will be given. After giving the notice, we need to give reply. Usually the reply will be REG 4 and the time limit will be 7 working days. After we give reply, again within 7 working days, the officer, if satisfied, he will pass the order, otherwise he will reject the application. So if he is satisfied within 15 working days from the date of application or 7 working days from the date of reply, else deemed to be amended. Okay, and the amendment order will be in REG 15. Then section 29 talks about cancellation of registration. There are total 8 situations where the registration of a person can be cancelled. In that, the first 3 cases, application can be made by the registered person or officer suo motu can initiate cancellation. That is in case of transfer or discontinuance of business, or in case of change in constitution resulting in change in permanent account number, or the person no longer liable to be registered. So in these 3 cases, either application can be made by the registered person or suo motu by the officer, and the form application for cancellation is REG 16, and other authentication is mandatory for registered person making application for cancellation of registration. Whereas there is suo motu cancellation, 5 cases where officer will initiate cancellation. In that case, a notice will be given in REG 17. What are those 5 cases? Number 1, contravention of the provisions of act or rules, specified provisions of act or rules. Number 2, a person who is under composition scheme is required to file annual return but not file within 3 months after the due date. A person who is under normal scheme has not filed returns for consecutive 6 months or 2 quarters, because 3 months is 1 quarter, so 2 quarters. Then registration obtained by fraud, or obtain voluntary registration not commence business within 6 months. So in these 5 cases, officer will initiate cancellation of registration. Even TDS TCS deductor also can make application for cancellation of registration. Now what are the contravention of provisions? So there are 5 cases where the registration will be cancelled by the officer. In that, 1 point is contravention of the provisions. What are those contravention of the provisions? So total 7 points we have. First 3, wrong address, wrong invoice, wrong ITC. Wrong address means they are not doing business from the place where they have obtained registration. Wrong invoice means invoice issued in contravention of the provisions, not giving proper details in the invoice. Number 3, wrong ITC. ITC availed in contravention of section 16. So that is this, does not conduct any business. Wrong address and wrong invoice and then wrong ITC. Then 3 violations. Violation of anti-profiteering. Suppose if I need to transfer the benefit of GST reduction in rate by way of reducing the price, but if I have not passed on the benefit by way of reducing the prices, but I enjoyed the profit, then it is known as profiteering. To avoid profiteering, they will be giving anti-profiteering order. If I am not complying with anti-profiteering order, then my registration will be cancelled. Violation of anti-profiteering. Violation of furnishing bank details. Bank details needs to be furnished within 30 days from the date of our registration or date of filing GSTR1, first GSTR1, whichever is earlier. Within the time limit, suppose if I have not filed the bank details, then also my registration will be cancelled. That is violation of furnishing bank details. Then as per rule 86B, 1% of my gross liability, FCM liability, I have to pay through electronic cash ledger. Suppose if I have not done that, that is contravention of rule 86B, then also it will lead to cancellation of registration. So first 3 points: wrong invoice, wrong address and wrong ITC, and next 3: violation of anti-profiteering, violation of bank details and violation of 1% of gross liability through cash ledger. And next point, if my liability in GSTR1 is greater than 3B for 1 or more tax periods, or my ITC, so in GSTR 3B is greater than ITC as per 2B for 1 or more tax period, that is rule 88C and rule 88D. So in that case also, that is a reason for cancellation. So that is contravention of provisions. Now be careful when they are asking about situations, you need to write these 8 situations. When they are asking about contravention of provisions, we need to write these 7 points. Then whenever they initiate cancellation of registration, they may suspend our registration. Suspension of registration is not mandatory, it is optional. And during the period when our registration is suspended, for our outward supplies we cannot give the tax invoice and recover the GST. For our inward supplies we cannot avail ITC, so therefore the returns cannot be filed. What is the period for which the registration will be suspended? So the registration will be suspended from the date. Suppose if we make application for cancellation, from the date we selected or the application whichever is later, so till the date of conclusion of cancellation proceedings. When officer initiate cancellation, again the same. So from the date officer initiates the cancellation, he will specify the date when the registration is suspended. From the date till the conclusion of cancellation proceedings, our registration will be suspended. So when the registered person has applied for cancellation or proper officer initiates cancellation, the proper officer may suspend his registration during the pendency of the proceedings. Suspension of registration can be without affording reasonable opportunity of being heard. Now see the procedure for cancellation of registration. Suppose if the application is made by the registered person, the application is in REG 16, and thereafter within 30 days the proper officer should decide either to reject the application or to grant the cancellation. Okay, registration, that is, suppose the proper officer is satisfied, so yes, so therefore reject the application. Proper officer is satisfied registration is liable to be cancelled, within 30 days they will pass an order for cancellation. Suppose not satisfied, they will reject the application, but this has to be done within 30 days. So or the proper officer gives a notice for cancellation in REG 17, then the person has to give reply to the notice within 7 working days. Suppose if he has not given reply, the order will be like they will pass a cancellation order. Suppose he gave a reply, proper officer satisfied with the reply, yes, so then he will drop the proceedings and he will not initiate cancellation. Whereas if the proper officer is not satisfied, then they will pass the order for cancellation, but that has to be done within 30 days. But this 30 days is not given in the law, this is based on CBIC direction. So what is the period for which registration is suspended? When he makes application for cancellation, starting from the date of submission of application or the date selected in the application, whichever is later, till the conclusion of cancellation proceedings. When the cancellation is initiated by the proper officer with effect from a date to be determined by him, he will specify one date from the date till the completion of cancellation proceedings. A registered person whose registration has been suspended above, for their outward supply they cannot give tax invoice, and inward supplies they cannot avail ITC, so therefore GSTR 3B cannot be filed. And whenever the registration is suspended, during that period they cannot file returns pertaining to that period, but they can file the returns pertaining to the prior period. Say continuous 6 months we have not filed returns, so officer gave a notice and registration is suspended. During this period we can file the returns pertaining to the period for which we have not filed returns prior. So now automatically there will be suspension revoked, so we can continue in the registration. Then there is something called as revocation of cancellation of registration, section 30. Suppose as per section 29 cancellation order is passed, now the person can go for revocation of cancellation. Now the time limit is previously 30 days plus 30 days plus 30 days, now the time limit is 90 days and it can be extended for a further period of 180 days by the commissioner or additional commissioner or joint commissioner. So once a cancellation order is served, from there within 90 days, or it can be extended for a further period of 180 days. But before making revocation application, all the returns till the date of cancellation needs to be filed. All the returns till the date of cancellation, pending returns which are not filed, for which cancellation is initiated, all those pending returns needs to be filed. And once the application for revocation is made, if the proper officer is satisfied, then within 30 days from the application they will revoke the cancellation order. Otherwise they will give a notice, and after they give the notice, within 7 working days we need to give reply. Thereafter within 30 days, if they are satisfied with the reply, either they will be revoking the cancellation order, or they will reject the application. And in this case also, whenever we make application for revocation of cancellation also, other authentication is mandatory. Now see this, suppose if the order of cancellation is 5/12 is the order of cancellation, and thereafter they passed a revocation, that is order of cancellation is say 5/12 is the order of cancellation, and thereafter I make the revocation application. So revocation application I have to make somewhere like 18 of January. I am making revocation application, and after making revocation application they will pass the revocation order. Say the revocation order is somewhere like 24th April, they passed a revocation order. Now in this case what will happen is that before the order of cancellation, that is up to December, whatever returns were there, that needs to be filed before the revocation application. But from the date of cancellation, that is order of cancellation, till the revocation order, all those returns not filed, that should be filed within 30 days after revocation order. So because up to cancellation, whatever pending returns that we need to file before application for revocation, from the date of order of cancellation till the date of order of revocation of cancellation, all the pending returns will be there now for this period, that should be filed within 30 days from revocation order. So with this we completed registration. Segment 14 and segment 13 related to returns payment process already we have discussed in part 3. So now we are moving on to segment 15, that is accounts and records e-way bill. So as per section 35, so here 35, 36 talks about accounts and records. 35 says that what are the various accounts and records required to be maintained by a registered person, and 36 talks about what is the period for which that accounts and records should be maintained. So what are the various accounts and records to be maintained by a registered person? Remember this keyword I formats. I for invoice supplies. Invoice supplies all purchase details along with the details of the suppliers, name and address and the details of the supplier, along with the relevant documents like tax invoice, debit notes and credit notes. So that is invoice supplies. Number 2, foreign trade, that is import and export of goods. So import of goods along with the details of bill of entries, export of goods along with details of shipping bills. And outward supplies, so outward supplies, so along with the details of the name and address and other details of the recipient, with the details of invoices, debit notes and credit notes. RCM purchase, out of the inward supplies, what are the purchase on which GST payable under RCM? IFOR, M for manufacture and production related records, but this is applicable only in case of a manufacturer, not by a trader or service provider. Then advances received, paid or adjusted. So advances received from the customers and advance paid to the suppliers, and adjustment of advances for the purpose of payment of liability. And tax details, input tax and output tax, and stock of goods along with the details of the place where that stock is stored. So these are the various accounts and records to be maintained by a registered person as per section 35. Where these accounts and records will be maintained. So these accounts and records will be maintained in the principal place of business pertaining to all place of business, whereas in every additional place of business we need to maintain the accounts and records pertaining to that additional place of business. Whereas in case of this tax details and stock of goods, it is not required for a person opting for composition scheme. So this tax details as well as stock of goods not required for a person opting for composition scheme. So they need to maintain I forma. So as per section 35, the above records will be maintained by every registered person in principal place of business, and records pertaining to additional place of business in each and every additional place of business. Whereas what is this period for which these accounts and records to be maintained? As per section 36, normal cases 72 months, that is 6 years, but in law you write, exam you write 72 months. So 72 months from the due date of furnishing annual return for a particular financial year. For example, if the financial year is 22-23, so 22-23 due date of furnishing annual return is 31st December 2023. 31st December 2023, 6 years, 24, 25, 26, 27, 28, 29. So till that time they need to maintain the accounts and records pertaining to this previous year or financial year 22-23. Suppose in that particular financial year we went for an appeal, then in that case 1 year from the outcome of the appeal or 6 years from the due date of furnishing annual return, whichever is later, not whichever is earlier, whichever is later. So 72 months from the due date of filing annual return or 1 year from the disposal of appeal proceedings, whichever is later. And every transporter or warehouse keeper, even though not registered, should obtain a unique enrollment number. Generally GST law is applicable only to a registered person. So all these accounts and records are also applicable to a registered person, but if there is a warehouse keeper or a transporter, even though their aggregate turnover not exceeding threshold limit, they need to get a unique enrollment number and they need to maintain necessary records related to their business. So this is about accounts and records 35, 36, and then 37, 38, 39, 40, 41, 42 and 43 we don't have, then 44, 45, 46, 47. So we have seen in returns. So then we have seen section 49, 50, 51 and 52, that is TDS TCS. So that is in payment process, and then 53 onwards, so till 59, so that we have 58 we have seen in refunds chapter. So this e-way bill is also a connecting area. This e-way bill is not given in any section, but it is given through the rule. E-way bill is a document which is to be given by the supplier or recipient or any other person who is causing movement of the goods. So this e-way bill contains the details of the goods which are to be transported along with the details of the vehicle. So basically whenever there is a movement of goods, e-way bill is required. Whereas e-way bill is not applicable in case of exempted goods, and it is not applicable even if the value of goods does not exceed 50,000 rupees. But while determining the value of the goods, you need to take GST, including GST, but excluding the exempted supplies. Suppose if a document contains both taxable supplies and exempted supplies, take out the exempted supplies and see the taxable supplies and add GST. If that exceeds 50,000 rupees, then only e-way bill is applicable. If it is less than or equals to 50,000, e-way bill not applicable. However, in case of goods sent on job work and in case of handicraft goods, even if the value does not exceed 50,000 rupees, definitely e-way bill is required. And e-way bill has two parts. Part A contains the invoice details and part B contains the vehicle details. So part A contains GST and details of supplier, recipient, document number and reason for transportation, whereas part B comprises of transport details. And what is the validity of the e-way bill? So e-way bill once generated will be having a validity of 1 day for every 200 kilometers or part thereof. In case of over-dimensional cargo or multi-mode transportation where one leg of the journey is by vessel, then it will be 1 day for every 20 kilometers or part thereof. For example, if the distance is 480 kilometers, so 480 kilometers means the validity will be taken as 3 days. So first 200 kilometers 1 day, next 200 kilometers 1 day, and remaining 80 kilometers it will be 1 day. So like that the validity will be counted, and the validity will be starting from midnight of the day in which e-way bill is generated. So it will be counted from the midnight in which e-way bill is generated. For example, so today morning the e-way bill is generated, today midnight to tomorrow midnight is 1 day, and thereafter next day midnight is another day. So like that validity is counted. So validity will expire by midnight, and within 8 hours from the expiry of its validity, the e-way bill can be extended if the transportation or the movement is not completed within that time. Suppose if the validity is over and still the goods are being moved, so then it is as good as the goods are transported without e-way bill and the consequences will be arising. So see, we have some FAQs on e-way bill. So when e-way bill is not required, if at all we transport the goods through non-motorized vehicle, bullock cart, horse cart, etc., e-way bill not required. If the goods are transported between the customs places, that is between the airport, port, or land customs station or container freight station, inland container depot or customs warehouse. So between those places, because the goods are under the supervision of customs officer, so that do not require e-way bill. That is second point and third point. And fourth point, transit cargo to Nepal and Bhutan. Nepal and Bhutan landlocked countries. Goods are originally unloaded in India and thereafter from India to Nepal and Bhutan it will be going, so that do not require e-way bill. And movement of goods for Ministry of Defence, so that do not, Ministry of Defence goods in whichever mode it is transported, e-way bill not required. And empty cargo containers are being transported because there is no goods inside that container, but the container itself can be taken as goods, but that do not require e-way bill. Then consignor transporting goods to or from between the place of business and a weight bridge. So first the lorry will go to the weight bridge to take the weight of the lorry. So that lorry do not contain goods, so therefore e-way bill not required. Now again the lorry will return to the factory and the goods will be taken into the lorry. Now the lorry will go to the weight bridge for the purpose of taking the weight of the lorry with goods. Now as the goods are there inside the lorry, if the movement is within 20 kilometers, e-way bill not required. If the movement is beyond 20 kilometers, e-way bill is required. Then goods being transported by rail, where the consignor of the goods is the central government, state government or local authority. So this is point number 8. This also do not require e-way bill. The difference between 5th point and 8th point is that in the 5th point it belongs to Ministry of Defence, whereas in the 8th point it belongs to government but only rail, whereas here it can be by any mode. The next one, goods specified as exempted from the e-way bill requirement in the respective states. So that also will be taken. And there are some goods which are given in these rules. So that is transportation of certain specified goods, LPG for supply to household and non-domestic exempted category customers. So that is basically that red color cylinders transportation do not require e-way bill. This is other than dealer of cylinder. Suppose if the dealer of cylinder is transporting, let it be red color or the blue color, that will definitely require e-way bill. But a consumer is taking the cylinder from the location of the dealer to his house, so then that do not require e-way bill. Kerosene oil sold under public distribution system, then postal baggage, and then natural or cultured pearls or any jewelry or silver or articles, precious articles, so that do not require. But imitation jewelry, that is not jewelry, that requires e-way bill. And used personal and household effects. So whether e-way bill is required for movement of goods is not for supply. So even though the movement is under supply or without supply, e-way bill is required. If it is under supply, tax invoice plus e-way bill. If it is without supply, delivery challan plus e-way bill. Whether the 50,000 limit is for taxable goods or exempted goods, so it is for taxable goods. If there is exempted as well as taxable, take out exempted goods and check the value. While computing invoice value, whether GST to be included or not, yes, GST needs to be included. Who will generate the e-way bill? Generally, e-way bill will be generated by the registered person who is causing the movement of the goods. If the supplier is registered and he is causing movement of the goods, supplier will be generating part A of the e-way bill. So he will enter the part A details. Suppose if the supplier is unregistered, the recipient is registered, the recipient is causing movement of the goods, the recipient will enter the part A details. If both supplier and recipient are unregistered, the transporter will enter the part A details. Alternatively, either supplier or recipient can enroll as citizen of India and they can enter the part A details. And so whether transporter is required to generate e-way bill even if the value of each consignment does not exceed 50,000 rupees. Yes. So generally there are 10 consignors who are sending the consignments through the transporter and each consignment value does not exceed 50,000. So suppliers will not be generating e-way bill. But all these e-way bills cumulatively, if you see, it exceeds 50,000 rupees because these 10 consignments transported in a single lorry, the lorry value exceeds more than 50,000 with respect to all the consignments. Now this transporter, for each consignment separately he need to prepare a e-way bill plus all these consignments, a consolidated e-way bill will be generated. So transporter should generate e-way bill, so EWB1 with respect to each consignment and EWB2 consolidated e-way bill individually for each consignment even though the value is less than or equals to 50,000. In aggregate it exceeds 50,000 due to that reason. Then blocking of e-way bill. If we are not filing GSTR1, GSTR3B or CMP8 for consecutive 2 quarters, then e-way bill will be blocked. So, but e-way bill will be blocked only with respect to outward movement of goods. So that is for if a person has not filed the returns for their inward movement. If a person has not filed the returns With respect to their inward movement, there is no issue. So e-way bill can be generated. With respect to their outward movement only, e-way bill is not possible, and that e-way bill cannot be generated by transporter, supplier, recipient or any other person. So e-way bill generation facility is blocked only with respect to outward movement of goods by registered person who has not filed returns as above. However, e-way bill can be generated in respect of inward supplies. And other points, in case of bill to ship to transactions. So I am delivering the goods to a third person and I am raising invoice to the recipient. In that case, one e-way bill is sufficient, even though there involves two supplies. And multi-vehicle updation is possible in e-way bill up to some distance in one vehicle, thereafter another vehicle, multi-vehicle updation is possible. Then once the part A details are entered, the part B, that is vehicle details, needs to be entered within 15 days. So part B should be updated within 15 days from updation of part A. E-way bill should be accepted by the recipient within 72 hours of generation or delivery, whichever is earlier. And part B, who can update either by the supplier or recipient or by the transporter, whomsoever knows the vehicle number, they will be updating the part B details. And movement of goods, if it is taxable goods under supply, then tax invoice plus e-way bill. If it is without supply, delivery challan plus e-way bill. When it is exempted goods, so tax bill under supply, bill of supply, and without supply, delivery challan, e-way bill is not required in that case. So these are the provisions with respect to accounts and records and e-way bill. So refunds under GST already we have discussed, and the next area that we have is assessment and audit. In this assessment and audit, the first few areas is related to interest computation, which we have come across in many places. First, section 50 subsection 1 interest talks about interest on account of delay in payment of tax or short payment of tax. So that rate of interest is 18% per annum and it will be computed from the first date after due date. So the due date depends upon the due date of GST or 3B, and first day after due date till the date of payment of GST. Whereas section 50 subsection 3 interest is on account of wrong availment and utilization of ITC, the interest rate is 18% per annum. It is first day after utilization till the date of payment of GST. What will be considered as the date of payment of GST? Date of filing 3B or date of making payment through DRC3, that will be taken. Whereas section 60 interest is talking about provisional assessment. So usually when a person is unable to determine what is the value or the rate of GST, that person can make an application for provisional assessment, wherein the officer will ask the person to provisionally pay some amount, and thereafter upon finalization some differential amount will be either payable or it will be refundable to that person. Suppose if the differential amount is payable, then what will be the rate of interest? 18% per annum. And in this case, the interest will be computed as usual from the first date after due date pertaining to the month in which the provisional assessment is resorted. So first day after the due date of the month for which tax is provisional assessed till the date of payment of the differential amount. Whereas section 16 is in case of non-payment of consideration to the supplier within 180 days from the date of invoice. So much of the ITC avail needs to be reversed along with interest 18% from the date of first date after utilization of ITC till the date of addition of that ITC to the liability. If you don't have, and that is reversal. So if you don't have the balance in ITC, then you will make the payment. So then 17 read with rule 42, that is we need to compute the provisional D1 and D2 which we are doing monthly basis, plus final D1 and D2 needs to be computed. If the final D1 D2 is more than the provisional D1 and D2, so which is already reversed, that differential amount we need to reverse in ITC, and again interest will be at the rate of 18% per annum from the first April of the succeeding financial year. Means we need to do this comparison at the end of the financial year. So first April of the succeeding financial year till the payment of such difference. Whereas next one is section 17 read with section 43. This is reversal of ITC pertaining to capital goods. So in case of capital goods, what will happen is that we will be availing the ITC initially and thereafter we will reverse over a period of 60 months. So now in this case the interest rate will be 18% from the first date after availment of ITC till the date of addition of the proportionate ITC. Whereas section 56 interest on account of delay in refund, usually refund should be granted within 60 days from the date we make application for refund. If the refund is not granted within 60 days, from 61st day the interest will be computed at the rate of 6% per annum till the date of refund. Whereas section 56, there is another refund which is arising on account of any adjustment order or appellate order, etc. Then that is court will be granting the refund. The interest rate will be 9% per annum, again same time limit, 61st date from the date of application till the actual date of refund. So here due date refers to due date of 3B, usually 20th of the month following every month will be taken. Suppose if there is any delay in filing 3B, then the interest will be payable on net liability provided the liability is reported in 3B. Suppose if the liability is not reported in 3B, it is pertaining to 1 month which is paid in the other month. So then in that case the interest will be computed on the gross liability. Then assessment under GST, basically we have, so section 59 onwards covered under this. So 59, 60, 59 talks about self-assessment, 60 provisional assessment. So up to 59, that is 58 is refunds chapter. So 59 self-assessment, 60 provisional assessment, 61 scrutiny assessment, then 62 and 63 best judgment assessment, and 64 summary assessment. So here what happens is that, so whenever a person is able to compute his GST payable, then it will be called as self-assessment. Whenever a person is unable to compute how much is the GST that he need to pay, he will request the officer to compute, that is called as provisional assessment. Whereas scrutiny assessment is whenever the self-assessment is completed and the return is filed, the officer will be taking up the return for scrutiny, and if everything is fine and everything is perfect, so then the assessment is completed. Otherwise, so the officer will initiate any one of the actions like either audit or recovery, etc. Whereas then section 62 and 63 talks about best judgment assessment. In that, two best judgment assessments are there. Number one, with respect to non-filers of return, a person is required to file returns but he did not file the return. In that case, so best judgment assessment will be initiated under section 62. Whereas in case an unregistered person who crossed the threshold limit but he not got registered, or he is making interstate supplies or covered under 24 but not got registered, so there is an unregistered person who is having some liability but he did not pay the liability, to initiate recovery, so they will be passing an assessment order under section 63. So then 64 talks about summary assessment. So in case when a person is evading the GST and the proper officer identified that and delay in passing the order, the person may escape from payment of GST, then they will invoke summary assessment order under section 64. Basically, assessment order is for the purpose of computing the GST payable, that is about assessment. Thereafter, the recovery order will be given under section 73 and 74. This assessment order is also in a way for the purpose of recovery only, and recovery order also separately 73 and 74 that we have. So now in this case, let's see about section 59 self-assessment. So status of the person is a registered person, and by registered person note is not applicable, and situation, every registered person has to assess the tax payable and they will furnish the return. What is the time limit for return? The due date of return will be taken. Officer to take any prior permission not applicable, withdrawal of order not applicable, and there are no consequences. Whereas if you see provisional assessment section 60, so it is not on the registered person, it is on the taxable person. Taxable person means a person who is liable to get registered, or who is already registered will be coming under a taxable person. So who will do this provisional assessment? It is done by the proper officer, and any notice will be given? No, because this person is only making application, so there is no question of notice. Situation when provisional assessment will come into picture, when the taxable person is unable to determine what is the value of goods or services or the GST that is payable. In that case, provisional assessment will come. So what is the time limit? So for the provisional assessment order should be passed within a period of 90 days from the date of receipt of such request. So once we make application for provisional assessment, within 90 days the provisional assessment order should be passed, and thereafter once the provisional assessment order is passed, so within 4 years, so 6 months plus 4 years, the final assessment order should be passed. So two time limits you need to remember. First we make application, so within 90 days they will pass a provisional assessment order. So after passing provisional assessment order, the final assessment order should be passed within 6 months. It can be extended for a further period of 6 months and further 4 years. So by the commissioner from the provisional assessment order. Officer to take any permission, no. Withdrawal of order, no. Consequences, what will happen? So calculate the final assessment amount and the provisional assessment amount, and suppose if it is positive, means what? Final assessment amount is greater than the provisional assessment amount, the differential amount is payable along with interest at the rate of 18% per annum from the first date after due date of the month for which we resorted for the provisional assessment till the actual date of payment. Suppose if it is negative, what is negative means? The final assessment amount is less than the provisional assessment amount. So when it is negative, so what will happen? So then we will get the interest. Refund, first we will get the refund. Suppose if the refund is not paid within 60 days, then from 60 days from the date of application, then from 61st day the interest will be payable to us. Then in case of scrutiny assessment will come whenever there is a self-assessment. So a self-assessed return will be taken up for scrutiny as per section 61 by the proper officer, and the proper officer will give a notice if there is any discrepancy. So mainly scrutiny assessment is in order to verify the correctness of the return. Proper officer may examine the return and seek explanations. So time limit, they have not given any time limit, but literally we need to connect the time limit to 73 and 74, because there is a time limit to give the notice for the purpose of recovery. So the recovery order under 73 needs to be passed within 3 years from the due date of furnishing annual return, whereas 74 needs to be passed within 5 years from the due date of furnishing annual return. So this 3 years and 5 years is the time limit for doing the recovery. So due to that reason, here when they take up the return for scrutiny, they should complete it within that time, otherwise recovery cannot be made. So logically the order under section 73, 74 before that, so they need to complete this scrutiny assessment. Officer to take any permission, no. Withdrawal of order, no. Consequences, if the explanation is not obtained within 30 days or extended period. So what happens is that first they will be giving a notice, and thereafter they need to seek the explanation. The explanation, that is reply, should be given within 30 days. Suppose if the reply is not given within 30 days, or the registered person fails to take corrective measures, so the proper officer may conduct audit or initiate any recovery. So audit can be either special audit or departmental audit. Departmental audit under section 65 or special audit under section 66, or they can initiate search, so under section 67, and they can also, if they have sufficient evidences, then they can initiate recovery under 73 and 74. Okay. So then in case of best judgment assessment, section 62, when is it applicable? So there is a registered person, and that person has not filed the returns. Registered person failed to furnish the return within 13 days from the GSTR 3A notice. A notice will be given under GSTR 3A. So if the returns are not filed, and after that notice under 3A, the return should be filed within 15 days. Otherwise, they will initiate best judgment assessment, and the best judgment assessment is done by the proper officer. And the time limit for best judgment assessment is 5 years from the due date of furnishing annual return for the relevant financial year. Within a period of 5 years from the date of 31st December of the financial year for furnishing the annual return to which the tax paid pertains. So simply remember, 5 years from the due date of filing annual return for the relevant financial year. And there is no permission to be taken by the officer. Withdrawal of order, yes. There is a facility of withdrawal of order when. So as we have not filed the return within 15 days, so the officer initiated best judgment assessment, and they pass a best judgment assessment order. Once a best judgment assessment order is passed within 60 days, previously it was 30 days, within 60 days, now that's an amendment. Within 60 days from the assessment order, best judgment assessment order, if you can file the returns. So what will happen? So whatever is the best judgment assessment order, that will be withdrawn, and as per your return only you will be liable to pay. So within this 60 days, but it can be extended for a further period of 60 days. So with a late fee of 100 rupees per day, such order shall be deemed to have been withdrawn. However, interest is payable. Here 100 rupees per day, here it is for the purpose of this section 62, but the regular late fee is also payable. What is it, regular late fee? So whether within 60 days or beyond 60 days, as there is a delay in filing return, so we need to pay the regular late fee. Okay, that is this point, so please keep in mind. So regular late fee for delay in filing returns, regular late fee for delay in filing returns under section 47. So there is one section 47 which talks about the late fee. You can refer that section 47 in the book. That's it, book, it is there. So we have discussed in the returns chapter. So regular late fee for delay in filing returns under section 47 is payable whether such return is filed within 60 days or beyond 60 days. Within 60 days or beyond 60 days, when you are filing within 60 days or beyond 60 days, you need to pay the regular late fee, under section 47. But this is late fee under section 62. What is that late fee under 62? Suppose if you are not filing returns after best judgment assessment order within 60 days, then for every day delay you need to pay 100 rupees. Now this is apart from that regular late fee. Okay. So then interest is also payable naturally, because there is a delay in filing returns means there is a delay in payment of tax. So interest is payable. So if you feel like best judgment assessment order you don't have to pay. So then there is an option available to that person in case of section 62, that is best judgment assessment on account of non-filers of return. Whereas there is another best judgment assessment under section 63. This is on the unregistered person, where a taxable person failed to obtain registration or his registration got cancelled but still there is some pending liability. So in that case, proper officer will do the assessment and an opportunity of being heard, a notice will be given before passing the best judgment assessment order. The time limit for this best judgment assessment order is also same. So within 5 years from the due date of furnishing annuitant for the relevant financial year, and officer to take any permission, no, and withdrawal of order also, we don't have any withdrawal of order. So whatever withdrawal of order that we have seen in case of previous section 62 is not applicable in this case. So consequences, either pay as per the assessment order, or if you are not satisfied, go for the appeal. If not satisfied with respect to appeal order, then you can prefer an appeal. Whereas in case of summary assessment section 64, so this is also like income escaping assessment. So what will happen, proper officer will come into the premises and they will be checking that or they will check the goods in the transit, and they came to know that the goods are liable for confiscation and the person has contravened and there is a evasion, he need to pay, and he has reasonable evidence to believe that delay in passing assessment order, the person may escape from payment of GST. So as per section 64, on the taxable person, the proper officer, there is no opportunity of being heard. Everywhere there is opportunity of being heard, notice will be given, but this is the only case where without notice they will pass directly the assessment order. What is the situation? The proper officer has evidence that the taxable person has incurred a liability, and the proper officer has sufficient grounds to believe that, so delay in passing an assessment order may adversely affect the revenue. These 2 points you need to write. So usually section 64 as a theory question they will be asking, the proper officer has evidence that the taxable person has incurred a liability, and proper officer has sufficient grounds to believe that, so delay in passing an assessment order may adversely affect the interest of the revenue. So then they will pass a summary assessment order, and there is no time limit for summary assessment order, but the person who is passing the summary assessment order, the officer, to take the permission of the additional or joint commissioner, because without notice they are passing an order. Due to that reason, withdrawal of order, yes, so either pay, that is in case when the order is erroneous, so they can withdraw the order, or upon request of the person to proceed under the regular assessment also, the order can be withdrawn. So pay as per the assessment order, or if the order is erroneous, proper officer may withdraw such order and follow the procedure under 7374, the regular demand and recovery procedure. Then this is about assessment under GST, then audit under GST. So here it is up to section 64 summary assessment, then 65 and 66 is audit under GST. So in this section 65 and 66, section 65 talks about department audit and section 66 talks about special audit, and previously we had statutory audit under section 35 subsection 5, that is now omitted, so which is not applicable. So GSTR 9 and 9C. 9C was previously an audit report, and now 9C is just a self-certified reconciliation statement which is required to be filed by every registered person whose aggregate turnover in a financial year exceeds 5 crores. And this department audit section 65 is conducted by the commissioner or any other officer authorized by him. So but section 66 special audit will be conducted by CR CMA professional who is nominated by the commissioner. So when this audit is conducted, department audit usually based on some frequency they will be conducting, whereas that is whenever they have reasons to believe that there is some evasion, so immediately they will do the department audit. Whereas special audit will be conducted, so whenever there are some discrepancies in the valuation or the ITC, value of supply or the ITC. Then time period of audit, department audit should be completed within 3 months, and it can be extended for a further period of 6 months, whereas special audit should be completed within a period of 90 days, plus it can be extended for a further period of 90 days, and audit report shall be submitted to. In case of department audit, the report will be submitted to the registered person as well as to the superior, that is commissioner, within 30 days from conclusion of audit, whereas in case of special audit, so that audit report will be given only to the jurisdictional ACDC. And expenses of audit, who will bear the expenses for audit? So in case of special audit, the report will not be given to the registered person, keep that in mind, and expenses will be always borne by the department, and scope of audit in department audit, everything can be verified, whereas in special audit the scope is restricted only for valuation and ITC. And notice is not there in case of special audit, just a direction to get audited is issued, but in case of department audit, a 15 days prior notice, working days prior notice will be given before commencement of the audit. What if already audit is completed under any other law or under another section? Then this section will be applicable. So it's not that if audit is completed under any other law, this audit is not applicable. So this audit will also be applicable. And can the audit be done for a part of the year? Yes, it can be done for a part of the year. For example, we made registration only in the month of July. July to March is not even a year. So, but for July to March, can the audit be conducted? Yes, for part of the year also audit can be conducted. Then in this chapter we have some more sections, that is liability to pay GST in special cases. So here you don't have to focus more on remembering the sections, but you should be able to remember what are the provisions. So mainly for MCQ purpose or short note questions it may be asked. So what is that we are discussing here? Generally the liability is on supplier and the recipient, but here in some special cases the liability is on some other person. Who is that some other person? In case of transfer of business, so whenever there is a transfer of business, so not only the transferor but also the transferee jointly and severally liable with respect to the dues before the date of transfer. For example, transfer happened from 1/4/2024. Now up to 2023, whatever is the liability, transferor and transferee both are jointly and severally liable, whereas they, after the date of transfer, transfer is only liable. And in case of agent and principal, if the agent is acting on behalf of principal, so no doubt agent is raising the invoice and agent is liable, but principal is also liable for the dues of the agent. So agent and principal jointly and severally liable. Then in case of amalgamation or merger of two companies, so even though in principle they got the approval, but only when the court passes the order, then only they were called as amalgamated or merged companies. Until that point of time, if there is any transaction between them, that will be treated as transaction between two different parties and liability to pay GST arises. Then liability in case of company in liquidation. So whenever a company is going into liquidation, a public limited company, an official liquidator will be appointed and that person should intimate his appointment within 30 days after his appointment to the commissioner, and the commissioner will notify what are the dues against that company within 3 months, and he need to consider that amount for the purpose of payment as priority payments. But this is subject to IBC. What if the company is a private limited company? In case of a private limited company which is going into dissolution or liquidation, so usually for partnership only we say dissolution, for a company we call it as liquidation. So whenever a private limited company is going into liquidation, the partners of the private limited company are jointly and severally liable. Whereas if the company, private limited company is continuing, it is not into liquidation, but the company has to pay some dues, can that be recovered from the directors? Yes. If the company is a private company, all directors are remaining liable jointly and severally. What if the private limited company is converted into a public limited company? So then the directors will not have any personal liability. Then liability in case of partners of a firm. So all the partners and the firm jointly and severally liable to pay the dues. What about the retiring partner? If the retiring partner gives a notice of his retirement within 1 month from the date of his retirement, so he need to pay dues till the date of his retirement only if he gives a notice of his retirement within 1 month. What if he is not giving the notice of his retirement within 1 month? Then even after retirement, till the date he gives the notice of his retirement to the commissioner, he will continue to pay the dues even after his retirement. Okay. Then liability of guardians and trustees. Guardians and trustees are jointly and severally liable even though the minor has become major and the incapacitated person has become capacitated. So the liability will be always there on the guardians and trustees. Liability of court of wards. In case of court of wards, they will be appointing a official general, official trustee or administrator general or any manager. That person is liable to pay the dues. Then there are some special cases. There is a death of a person. So what is the liability of legal representative? If the business is continued, legal representative will remain liable jointly and severally full amount. And what if the business is not continued? The legal representatives are liable to pay the dues to the extent of the estate that they have inherited, to the extent of wealth they have inherited, to that only they need to pay the liability. And whenever there is a partition of HUF and assets are distributed between the members, and if there is any liability of the HUF, whether after partition the members are jointly and severally liable, yes, the members are jointly and severally liable even after partition. Same is the case of partnership firm. So when it is dissolved, all the partners will continue to remain liable jointly and severally. Same is the case of guardianship. So when it is terminated, so termination of guardianship and trust, the guardian and trust will remain liable. Then liability in other cases, that is, there is a change in constitution of the partnership firm, that is, newly a partner got admitted. That newly admitted partner will be liable for dues even before the date he was admitted as the partner. And when the partnership firm or HUF or AOP got discontinued. So even then the assessment can be completed, and suppose if it is dissolved, partners or members remain liable jointly and severally. So mainly these are asked in MCQs, or some short note questions can be coined based on this. Here you don't have to focus on the section number, but these provisions you need to remember. Now we are moving on to the next one, that is segment 18. Segment 18 is a very important area. In this segment 18, so we will learn about search, seizure, offences and penalties. So first the search and seizure we will see. So search and seizure, basically in two situations the search and seizure will happen. Situation number one, proper officer will come into the premises of the registered person and they will be checking the goods, and if there is any goods that are liable for confiscation, or any documents containing the details of the goods liable for confiscation, or any things so that is liable for confiscation, all those things will be seized, and thereafter a confiscation order will be passed. So this is section 67. Section 67 talks about the seizure and section 130 talks about the confiscation. So these two are connected. Section 67 read with section 130. So seizure and confiscation of goods from the place of business, section 67 read with section 130. Whereas another situation is seizure of goods during the transit. So when the goods are taken like from one place to another place during the transit, so the seizure search can be conducted by the proper officer, and that power to conduct search is given in section 68. And what if the goods are transported without valid documents, then the penalty and other provisions are given under section 129. So total 4 sections are connected in search and seizure, that is section 67 read with 130 and section 68 read with 129. So first we will see situation 1. So inspection was carried out. Here search or inspection is interchangeably used in GST law. So inspection was carried out at the business premises of the taxable person or taxable person. Taxable person means either registered person or the person liable to get registered, transporter or warehouse operator. Sir, can any other premises also be searched? Yes, any other premises also can be searched. So any other premises, any premises. Suppose if the department is having doubt that, so in any premises the goods are stored or the goods are kept or the documents are kept, so they can do the search with respect to any premises. If any unaccounted goods are found, that goods are liable for confiscation. Now as per section 67, so the proper officer will seize the goods. So seizure from the place of business, what they will seize, either goods, documents, everything will be seized, and after that they have two options. Option number 1, pay the appropriate tax and penalty. So seizure has happened. So now the person, that is from whose premises the goods and the records were seized, so he has to pay some tax. So either pay the tax plus applicable penalty. So the tax with respect to those goods, penalty under section 122 subsection 1. Whenever a person is dealing in goods liable for confiscation, so he need to pay penalty under 122 subsection 1, and that penalty will be 100% of the tax evaded or 10,000, whichever is higher. So that penalty is required to be payable. So pay appropriate amount and get it released, that is pay applicable tax and penalty under 122 subsection 1. Goods shall be released and all proceedings in this respect shall be deemed to be concluded. Again, as and when those goods are sold, are we required to pay any GST? No. First of all, these goods are not brought into the records. So therefore, whenever you are selling those goods, really in future we don't have to pay any GST, because already the tax has been discharged on those goods. Whereas option 2, furnish security and get the provisional release. Suppose if you don't have money to pay the tax, so but you need the goods, what you can do is that you can furnish the bond and the security, sufficient security, so that the goods will be released provisionally, and whenever we sell those goods, so we realize the money, at that time we will pay the tax and penalty. The proceedings are not concluded because this is only the provisional release of goods. Provisional release of goods by executing a bond covering the value. Now, suppose if the person has not exercised both the options, so he did not pay the tax and penalty or executed the bond, then a confiscation order will be passed. But they have not given what is the time limit within which the confiscation order will be passed. So a confiscation order will be passed by the department. So whenever the confiscation order is passed, what will happen? So far the possession only is with the department. Now the confiscation order is passed, means the ownership also will go to the department. Now once the confiscation order is passed, still the person on whom the confiscation order is passed is having an option to pay the fine along with tax and penalty. A fine can also be payable. So that fine is known as redemption fine. Upon payment of that fine, the goods will be released. What is the time limit within which he need to pay that fine? 3 months. So confiscation order plus redemption option So option to redeem goods by paying fine within 3 months. So what and all he need to pay? Tax and penalty payable along with redemption fine. Suppose if he is not paying the fine also within 3 months, what will happen? So then the confiscation order is invoked, so that the goods will be, ownership also will be transferred to the department. The department will sell those goods, realize the money, and that money they will keep in their pocket. So which means it will not be given to the owner of that goods. If the option is not opted, confiscated goods shall be disposed of and entire amount retained by department. Okay, entire amount retained by department. So it will not be given to the person. And suppose if the redemption option is exercised, how much is the redemption fine? There is no concrete or absolute amount of redemption fine. So it depends. Redemption fine in case of goods. So what is the maximum redemption fine? Market value of the goods minus tax chargeable thereon. So whatever is the market value of the goods minus tax chargeable, so that much can be the maximum redemption fine for goods. Now in this process, even the conveyance which contains the goods which are loaded in the business premises, there is a lorry in the business premises where the goods are loaded. So on that conveyance also the redemption fine is payable. So what is redemption fine for release of the conveyance? Tax payable on the goods transported thereon. So redemption fine, maximum redemption fine for release of the goods is market value of the goods minus tax payable thereon, whereas for release of conveyance, tax payable thereon will be taken. Then situation 2 is seizure of goods during the transit. So when the goods were during the transit, the goods were seized, and because the goods are not carrying proper e-waybill or proper documentation. So as per Section 68, conveyance carrying the goods are intercepted by the proper officer for inspection in transit. If the transporter was found transporting or storing such goods which are removed in contravention of the provisions of the Act, such goods and conveyance are liable for confiscation. Both goods and conveyance are liable for confiscation. So basically this is seizure during the transit. And here what happens, section 129, immediately after the seizure, they will be giving a notice for levying the penalty. So first a notice will be given within 7 days of verification of conveyance. Notice for what? Levying the penalty. After notice, within 7 days, so a penalty order will be passed. First seizure order, within 7 days notice. And after 7 days from the notice, a penalty order will be passed. Penalty order under 129 to pay the penalty within 7 days of service of notice after giving opportunity of being heard. So once a penalty order is passed, within 15 days of receipt of penalty order, we need to pay the penalty for release of goods. Otherwise, the goods will be disposed of by the department. Okay. So upon payment of penalty within 15 days of receipt of order, all the proceedings in this respect shall be deemed to be concluded. And the said period of 15 days shall be reduced in case of perishable goods. Now, so in the previous case, we need to pay tax and penalty, but here only the penalty is payable. We don't have to pay the tax. And what is the penalty that is payable? It depends. When the owner of goods is coming forward to claim release, or owner is not coming forward to claim release. If the owner is not coming forward to claim release, then who is coming forward? Transporter is coming forward to claim release. When the owner is coming forward, what will be the penalty? Suppose if it is taxable goods, the penalty will be 200% of tax payable. And if it is exempted goods, so it will be 2% of value or 25,000, whichever is lower. So this is the penalty payable under CGST Act. So the same amount of penalty. Remember, late fee provisions and penalty provisions will be common for CGST and SGST. So whatever is the late fee and penalty that we compute for CGST, that will be applicable for SGST also. But in question, they will be usually asking so and so section of CGST Act. Then we need to write only one penalty. Okay. And suppose if they are asking penalty payable, so now you compute both under CGST Act as well as under SGST Act, and you show the amount. Okay. So this is penalty under CGST Act, 200% of tax payable for taxable goods, exempted good, 2% of the value of goods or 25,000, whichever is lower. Whereas what is the penalty for release of the conveyance? For release of the conveyance, the penalty will be penalty payable for release of goods or 1 lakh, whichever is lower. So therefore, in two places the penalty comes as whichever is lower. So in the exempted goods, the maximum penalty is 25,000, whereas in case of release of conveyance, the maximum penalty is only 1 lakh. Suppose if the owner is not coming forward, what is the penalty? For taxable goods, the penalty will be 200% of tax or 50% of the value, whichever is higher. Not whichever is lower, whichever is higher. So 200% of tax or 50% of value, whichever is higher. Sir, usually 50% of value is only higher. Now sometimes when the compensation cess is also involved, so the 200% of tax may be higher. For example, CGST you take 14%. and compensation says somewhere like 18% you take. So then definitely it will be like more than 50% of the value. So due to that reason, so 200% of tax or 50% of the value, whichever is higher will be taken. Whereas in case of exempted goods, so 2%, here it will be 5% of the value of goods or 25,000, whichever is lower. For release of conveyance also same. So penalty payable for release of goods or 1 lakh, whichever is lower. So therefore the maximum penalty for release of conveyance is 1 lakh. So this is about the penalty in case of section 129. Now what is the time limit within which this penalty is payable? Again, are we required to pay any tax under 129? No. In case of situation 2, no tax is payable, only the penalty is payable. And the penalty payable for release of goods and conveyance, separately we need to pay that. If it is not paid within 15 days, what will happen? So rule 144 says that there will be recovery of penalty by sale of goods or conveyance detained or seized. So first they will dispose of by way of auction and they will realize the money. But in case of perishable goods, that 15 days can be reduced. Where the person transporting any goods or the owner of such goods fail to pay the amount of penalty under 129, that is within 15 days from the date of receipt of copy of order, the proper officer shall proceed for sale or disposal of the goods or conveyance through auction. And the set period of 15 days may be reduced in case of perishable or hazardous goods. Now they are realizing some money. What is that money? That is by selling that. So can it be entirely retained by department? No, because in the previous case they passed a confiscation order. Here they did not pass a confiscation order. So therefore, whenever they realize the proceeds, whenever 15 days we have not made the payment of penalty, they will dispose it off by auction, and first it will be adjusted towards the recovery process. That is, while conducting auction, some expenses will be incurred. So for that, then the payment of penalty under 129. So the balance amount will be given to the electronic cash ledger of the owner of the goods if they are registered. Otherwise, it will be credited to their bank account. Suppose if the person is not known, then the balance of the sale proceeds cannot be so paid within 6 months. So they will wait for 6 months, and within that 6 months, if no one is coming forward to claim that amount, so then it will be transferred to the consumer welfare fund. So this is about this 4 sections: section 67 read with section 130, section 68 read with section 129. Let's see the next aspect, that is types of offences and the penalty in case of those offences. So when it comes to offences and the penalty, so in this chapter we need to understand 4 aspects. Number 1, what are the various offences and that leads to penalties, and number 2, what are the offences that leads to imprisonment, number 3, what are the offences that leads to arrest, and finally what are the offences so which are compoundable. Compounding of offences, one concept is there wherein, so if you pay some compounding fee, so you will get immunity from the prosecution, that is imprisonment. So that is known as compounding of offences. So all these are connected. So first we will see, so what are the 4 aspects, what are the offences that leads to penalties, and second, what are the offences that leads to imprisonment, and then what are the offences that leads to arrest, and then finally offences which are compoundable. So this offence and penalties is a very, very important area, because so we have lot of amendments related to this offence and penalties topics. Okay, so let's see types of offences and that leads to penalty. First we have 122 subsection 1, bio discredits TFT. So these are the list of offences that you need to remember, and these offences, so full form I have given below. So what is that? Bio discredits TFT. B for books of accounts default. Books of accounts default means not maintaining books of accounts or maintaining false books of accounts or fake books of accounts, that is known as books of accounts default. I for invoice default. Invoice default means I am issuing invoice without supply, or I am supplying without invoice, or I am giving incorrect invoice. So that is called as invoice default. So books of accounts default, non-maintenance or false or fake books of accounts, and invoice default, supply without invoice. So I am making supply without invoice, or supply with incorrect invoice, or invoice without supply. or for obstructing an officer from doing duty. So an officer is coming into our premises for the purpose of inspection or any search, etc. So we stop the officer from doing his duties. Then D for dealing in goods liable for confiscation. So I am actually storing the goods which are liable for confiscation, selling the goods or buying the goods. So this is known as dealing in goods liable for confiscation, means unaccounted goods. If I am involved in any transaction related to unaccounted goods or goods without any invoice, then it is called as dealing in goods liable for confiscation. Then input service distributor default, which means that I am not supposed to take the credit, but I took the credit and I distributed the credit to my branches, or I distributed the credit in excess of the credit availment, that is known as ISD default. Or supply with GST of another person. So therefore, I am raising the invoice in someone's name and I am collected the GST from my customer. So that is on a supply with GST of another person. And in C, so bio discredits. So B for books of accounts default, I for invoice default, and O for obstructing an officer from doing duty. DIS, D for dealing in goods liable for confiscation, I for input service distributor default, yes, supply with GST of another person. Then credit C. In that C, we have collected an amount as tax or not paid within 3 months, collected tax not paid within 3 months. Remember, there are two aspects here. Collected tax not paid within 3 months. So which means that I am supposed to collect tax, I collected the tax and I did not pay within 3 months. So this is one aspect. The other aspect is collected an amount as tax. I am not supposed to collect the tax, but I have collected the tax and not paid within 3 months. That is known as collected an amount as tax. So representing as tax, I collected some amount. Then R for registration default. Registration default, non-registration. You are liable to get registered, but you have not got registered, or giving false information for registration. So you are giving some false information like fake documents, etc., and all for the purpose of registration, or forged documents. Then E for erroneous refund. You are not supposed to get the refund, but you claim the refund erroneously or wrongly. Then D for disposal of goods while detention or seizure is operational. So there is a detention order or seizure order that has been given with respect to a person, and which means that so that goods actually should not be dealt with. So seizure means automatically the possession is taken by the department, whereas detention means the goods will be still in that same place and you should not be like touching those goods, or you should not be dealing with those goods, you should not be selling those goods. That is known as detention or seizure is in operation. Now you try to break the seal and you try to sell those goods. So then in that case, so the goods are in the department's place and you have barged into their place and you have taken those goods, so and you have sold it. So this is known as disposal of goods while detention or seizure is operational. And ITC default, you are not supposed to take the input tax credit, but you have taken the input tax credit, fake credits. Then tampering with material evidence. Say department has got some material evidence like some documents or diaries or etc., so which contains a sensitive information or tax evasion information. You try to tamper those documents or tamper the pen drives, etc., so that the evidence is destroyed. So that is known as tampering material evidence. And suppression of turnover. So you have crossed the turnover, but if you cross the turnover, so a lot of provisions are attracting. So due to that reason, you try to suppress your turnover. That is bio discredits. Then TFT, T for TDS TCS default, F for failure to supply information or supplying false information or documents. Then T for transport related default. So these are known as transport related default means what? Transporting goods without valid documents. Okay. So these are the various offences under section 122 subsection 1, and these offences if committed by any taxable person means either registered person or a person liable to get registered, then the penalty will be 100% of the amount involved in the offence, that is tax or ITC or TDS TCS as the case may be, or 10,000 rupees, whichever is higher, that will be taken as the penalty. So it should be, already I told you, the penalties should be computed separately for GST and separately for SGST. 122(1)(a). So 122(1)(a) is a person who is beneficiary. So means he is not a person involved in the offence, but he is a beneficiary to the offence and he retains the benefit also of the offence. Two aspects: at whose instance the offence is committed and who is retaining the benefit out of that offence, then that person, on that person. So this is on any person who is beneficiary, means here basically at whose instance the offence is committed and he is benefiting out of that offence. Okay. So what are those offences? Triple I. Invoice default, ITC default and ISD default. Say for example, a person who created some fake registrations, and using these fake registrations some invoices are raised to the recipients and the recipients enjoy the ITC based on that. So now on the supplier registrations there will be penalty under 122 subsection 1, whereas the under invoice default, because of invoice without supply, so therefore on invoice default 122 subsection 1, on the suppliers there will be like penalty, whereas on the recipient who availed the ITC without proper documents, so that is called as ITC default. So on recipients only also there will be penalty, but on the person at whose instance this offence is committed, who is a mastermind behind these offences, so on that person the penalty will be levied under 122 subsection 1A. It is not the benefit that he has retained, the total amount involved in the offence, that is tax evaded or ITC availed or passed on. So that will be taken, not the amount retained. For example, 500 crores worth of fraud is involved, tax evasion is involved, but out of that 500 crores, 50 crores is the benefit that he derived. So not 50 crores, entire 500 crores will be taken as the penalty amount, 122(1)(a). Then 122(1)(b). This is a newly added provision. So this penalty is on e-commerce operator. So e-commerce operator already is covered under 122 subsection 1 under TDS TCS default. TCS default is there, but there is another penalty also here, 122(1)(b). What is that? E-commerce operator is allowing an unregistered supplier to make supplies through their platform. So unregistered supplier to make interstate supplies. Basically intrastate supplies are allowed, but interstate supplies, or allowing a person opting for composition scheme to make interstate supplies, or failure to furnish the correct details in GSTR 8. Suppose if it is related to TCS, so then it is already covered under 122 subsection 1, that is TCS TDS default. Okay, whereas if the e-commerce operator is allowing an unregistered person to make interstate supplies, or a person opting for composition scheme to make interstate supplies, or the e-commerce operator not giving proper details in GSTR 8, then the penalty will be 10,000 rupees or tax involved, whichever is higher. So this is a newly added penalty, and they can connect this with TDS TCS, the existing penalty also. Then 122 subsection 2. This 122 subsection 2 penalty is on the registered person. So this is not on any person, whereas 122(1) is on the taxable person, 122(1)(a) is on any person, 122(1)(b) is on e-commerce operator, whereas 122 subsection 2 is on registered person. 122 subsection 2 will come into the picture only when there is 73-74. As per 73, whenever there is short payment, non-payment, wrong availment of ITC, wrong utilization of ITC, or erroneous refund. So 5 cases: short payment of GST, non-payment of GST, wrong availment of ITC, wrong utilization of ITC, erroneous refund, on account of fraud, collusion, etc. That is, you have intention to evade. Then in that case, the recovery will be initiated under section 74. Whereas if there is no fraud and all, other than fraud, that is error, then there is no intention to evade, then the recovery will be initiated under section 73. Suppose if the recovery is initiated under section 73, so it is like a softer provision than 74, then in that case the penalty will be as per 122 subsection 2, wherein it says 10% of the tax involved, or 10,000 rupees, whichever is higher, that should be taken. 10% of the tax or ITC or refund, or 10,000, whichever is higher, should be taken. Whereas if it is on account of fraud, so means the demand and recovery is initiated under section 74. So there is an intention to evade. In that case, the penalty will be 10,000 rupees or 100% of the tax or ITC, whichever is higher, will be taken. So 73, 10% of tax or ITC or 10,000, whichever is higher. 74, 100% of the tax or ITC or 10,000, whichever is higher. And these both penalties is on registered person. And what are the reasons for which 122 subsection 2 comes? So 122 subsection 1 also gets attracted. So for that reason, one circular has been given which says that 122 subsection 1 and 122 subsection 2 are mutually exclusive. So only when there is demand and recovery under 122 subsection 2, that is 73-74. So only when a person is required to pay the tax or ITC, and along with that if penalty is levied, that is 73-74. The moment 73-74 is invoked, so then automatically the penalty will be under 122 subsection 2. So 122 subsection 1 will not be applicable. Suppose if recovery is not initiated under 73-74, then for recovering only the penalty, means there is no tax or ITC due by the person, so just the penalty is payable. For that reason 122 subsection 1 will be applicable. So remember, 122 subsection 1 and 122 subsection 2 are mutually exclusive. Then 122 subsection 3. So this is again on any person. Basically 122 subsection 3 is not on the main character, but it is on the supporting character. So a person who is not the main culprit in the offence, but he is assisting, in that case 122 subsection 3 will come. Offences where the person is not directly involved in any evasion, but may be party to the evasion. Then what is the difference between 122 subsection 1A versus 122 subsection 3? In 122 subsection 1A, at whose instance the offence is committed and they retain the benefit of the offence. But 122 subsection 3 is they are not retaining any benefit of the offence, they are just a party to the offence. So in that case, or a person has been issued summons to appear before the officer, but he did not appear before the officer, or a person has been asked to produce the documents, but he did not produce the documents. So then 122 subsection 3 penalty will be there, which is up to 25,000 rupees. Up to 25,000 rupees means any amount can be levied, so the maximum amount is 25,000 rupees. Whereas in this case we don't have up to, always it will be the standard penalty. Then 123. 123 is on a person who is required to furnish the information written under section 150. As per section 150, so whenever department is asking a person so to furnish the information written about a particular person, if he is not furnishing that information written, so then a notice will be given to that person to furnish the information. Even after notice also, if he has not furnished the details, so within 90 days from the date of the notice, then the penalty will be levied under 123. So first 150 empowers the jurisdictional commissioner or officer authorized by him to seek notified person from filing information written. If they are not filing information written, a notice will be given. After notice, within 90 days, if they are not furnishing the information written, then the penalty will be 100 rupees per day subject to maximum 5,000 rupees. Whereas 124 penalty is there. This 124 penalty is on any person required to furnish any information under section 151 fails to do so. So there is a person who is required to furnish some information under section 151. What is this information under 151 versus information written under 150? So basically 150 is about a particular person, but 151 is about the data. Say for example, I want to know the bank detail, like I want to know the name of the persons whose credits in the bank has exceeded more than 40 lakhs. So exceeded 40 lakhs. So I need the data of those people. Then it will be information under 151. I want to know the bank statement of a particular person, that is information written under section 150. So both cases we need to submit some information, whereas in 150 there is a timeline. So that is standard time is there, notice is there, within 90 days if you are not giving, then only the penalty will come into the picture. Whereas in case of 151, so 151 the time will be given by the officer itself. So empowers the jurisdiction commissioner to call for information from any person relating to any matter dealt with the connection with this act, and normal cases it will be up to 10,000 rupees, up to 10,000 rupees. If it is a continuing offence means repeated offence, then 100 rupees per day for the failure period subject to maximum 25,000. But here always it will be 100 rupees per day subject to maximum 5,000 rupees. Then 152 is any information obtained under section 150 and 151 cannot be used without giving the opportunity of being heard to the person concerned. So usually I will tell a standard example, that is like, say a department has got the bank statement of a person, and in that bank statement the credits is more than 40 lakhs. Now just like the department cannot ask the person so to register, because that 40 lakhs may be more than 40 lakhs may be exempted turnover also. So due to that reason, so the department cannot question him by telling that the person is not registered, so they cannot invoke any action. So first an opportunity of being heard should be given. So they should give a notice asking for the person, so that we got information stating that your credits is more than 40 lakhs and you have not registered. So we wanted to know the reason why you have not registered. So based on that notice and based on the reply, so then only they can initiate any penal action on that person. Okay, so that is this 152. Information obtained under 150 and 151 cannot be used without giving an opportunity of being heard to the person concerned. Then 125 we have a general penalty, and the general penalty is always up to 25,000 rupees. Again all these penalties are under CGST Act. The same amount of penalties payable under SGST Act, but we don't have any penalty provisions under IGST Act. Penalty provisions or late fee provisions we don't have under IGST Act. Now this general penalty is applicable in the case where there is no specific penalty that is prescribed. And 126 talks about the general disciplines relating to penalty. No penalty for minor offences. What is a minor offence? If the amount of tax or ITC involved in the offence is less than 5,000 rupees, then it is known as minor offence. So in case of minor offence there is no penalty. So on second case, suppose if the offence is easily rectifiable and made without a fraudulent intent or gross negligence, then also there is no penalty. No penalty in two cases: if it is a minor offence that is less than 5,000 rupees, not equal to 5,000 rupees, less than 5,000 rupees, or the offence is committed without fraudulent intent and it is easily rectifiable, then also penalty may not be levied. But here the power to waive of the penalty is not applicable in all the sections. Only those sections where we have up to an amount as penalty, in that case only the officer is having power to waive of the penalty. What are those cases? That is where we have up to like amount. So 122 subsection 3. So this place 126 will be applicable. Again general penalty also up to 25,000. There also it is applicable. 124 also up to 10,000. Here also this section will be applicable. So applicable in case of 122 subsection 3, 124 and 125. Then 127, only for levying penalty a notice to be given, and that notice will be given under 127, where proper officer is of the view that the person is liable to pay penalty and the same is not covered under any of the other proceedings. So any of the proceedings means like so suppose if there is a demand and recovery, so they will be anyhow giving an order. And if there is assessment order, already order is there. Apart from that, just to recover the penalty, how the notice and order can be passed, that is under section 127. He may levy penalty after giving a reasonable opportunity of being heard. Then 128 versus 126. 126 is waiver, power to waive of the penalty on the officer, whereas 128 power to waive of penalty on the government. So government may by notification waive in full or part any penalty referred to in 122 subsection 122 all sections, 123, 125 or any late fee. Except 124, all the penalties can be waived off by the government. Even the late fee which is levied under section 47 for delay in filing returns also can be waived off. And 133, this is on the officer who is engaged with respect to certain duties under GST law, either the government officer or the person who is working in the GST portal. So officer engaged under this act willfully discloses any information or contents of any return otherwise than in execution of his duties. Suppose if he is sharing that information, taxpayers information in the return is a sensitive information, if that is disclosed with any other person, so then in that case on the officer the penalty will be up to 25,000 rupees or imprisonment up to 6 months or both. Unless the officer is required to disclose that information in execution of his duties, it's okay, otherwise this penalty will be applicable. So up to 25,000 or 6 months or fine. 6 months, that is up to 25,000 is a fine, or imprisonment of 6 months, or both can be levied. So these are the various offences that leads to penalties. And then we have offences that leads to imprisonment and offences that leads to arrest. Okay, so first we will see what are the offences that leads to imprisonment. So that is the next aspect we need to see. You can see that in the next page, imprisonment section 132, so page 164, it's amended area. So previously lot of offences were covered under imprisonment, but now it is only ICEBID, ICE bid. Okay, so what is that? I for invoice default. What are the invoice default? Two invoice defaults are there: supply without invoice, invoice without supply. So both these offences are covered here. And C, there are two C's actually: collected amount as tax, collected tax not paid within 3 months. But collected tax not paid within 3 months is not an offence for imprisonment, but collected an amount as tax, representing as tax you collected some amount and not paid within 3 months, so that is an offence for imprisonment. E for erroneous refund, you are not supposed to get the refund, but you claim the refund, so erroneous refund. Then B for books of accounts default, again I for ITC default. And D, there are two Ds: dealing in goods liable for confiscation, disposal while detention or seizure is operational. So disposal while detention or seizure is operational is not an offence for imprisonment, but dealing in goods liable for confiscation is an offence for imprisonment. So therefore whatever short forms that we remember in biodiscredits TFT, the same short forms: ICE bid, I for invoice default, C for collected amount as tax not paid within 3 months, B for books of accounts, E for erroneous refund, B for books of accounts default, I for ITC default, and C for, so that is D for dealing in goods liable for confiscation. So in these offences, plus abetting to commit or attempting to commit these offences. Abetting means supporting these offences, or attempt to commit these offences, you are trying to commit these offences. So in this case the imprisonment will be applicable under section 132, and the imprisonment will be for a particular period. And here what we have seen so far is when the imprisonment will be attracted. And see this note: collected tax but not paid within 3 months is not an offence for imprisonment, but collected an amount as tax but not paid within 3 months is an offence for imprisonment. Now what you need to remember is that the imprisonment schedule. The imprisonment schedule is very simple. So first we need to see what is the tax involved, tax or ITC involved in that particular offence. So if it is greater than 1 crore, then up to 1 year. If it is greater than 2 crores, then it is up to 3 years. If it is greater than 5 crores, then it is up to 5 years. That is in case of first time imprisonment. Okay, so first you need to remember 1, 2, 5, 135, 125, 135, 125, 1 crore, 2 crore, 5 crore, 135, 1 crore, 3 crore, 1 year, 3 year and 5 year. Okay, so you need to remember this way: 1, 2, 5 and 1, 3, 5. So this 1, 2, 5 is crores. Okay, then this 135 is years: 1 year, 3 years and 5 years. Okay, but this is the maximum imprisonment. So there is a minimum imprisonment up to 1 year, up to 3 years, up to 5 years. But in all these cases there is a minimum imprisonment of 6 months plus all these plus fine. So we have to pay fine also, and that fine will be imposed by the court which is passing the imprisonment order. But in this 1 crore point, there is one important point. What is that? This 1 crore provision is applicable only in case of invoice default. That to which invoice default? So invoice without supply, only in that case, invoice without supply. Okay, previously this was not applicable, now they have amended. So more than 1 crore is applicable only in one case. Which case? Invoice default. That to which invoice default? So invoice, issues invoice without supply, that is greater than 1 crore. But all other offences, so it will be applicable for more than 2 crores, more than 5 crores only. So other offences. But in that other offences also, books of accounts default will be up to 6 months or fine or both. So here other offences, what are these other offences? Sir, whether these other offences includes invoice default also? Yes, invoice default, both invoice default, that is supply without invoice or invoice without supply. Okay, so in these both cases, in these other offences, what and all will come? ICE bid minus B. Because for books of accounts default, always the standard imprisonment is there if it is first time. See, if it is subsequent imprisonment, it's no doubt. So it is up to 5 years plus fine. 5 years plus fine, and the minimum imprisonment will be 6 months. So confusion will not come at all. So in all the case of ICE bid, in all the case of ICE bid, okay, in all the case of ICE bid, it will be subsequent imprisonment given means up to 5 years plus fine, and the minimum imprisonment for 6 months. There is no other provision. Whereas when it is first time offence only, so there is a difference in the provision. What is that you need to remember? First you need to check books of accounts default. If it is a books of accounts default, up to 6 months or fine or both, that will be taken as the imprisonment. And if it is other offences, okay, in that other offences, only if it is more than 2 crores or more than 5 crores, then only imprisonment will be applicable, up to 3 years, up to 5 years plus fine minimum 6 months. But more than 1 crore, only one offence, that invoice default. In that invoice default also, not supply without invoice, invoice without supply. See, supply without invoice is normal, supply without invoice is usual, and that is okay. But invoice without supply means because of this the other person will enjoy the ITC. So due to that reason, invoice without supply, more than 1 crore itself, imprisonment will be attracted up to 1 year and fine. So this table you need to remember. How to remember this? 3 simple point. Books of accounts default, always up to 6 months plus fine, 6 months or fine or both. Then so greater than 1 crore up to 1 year, but only in case of invoice default, that to invoice without supply. All other offences only greater than 2 crores. So greater than 2 crores, so up to 3 years, greater than 5 crores up to 5 years. Subsequent imprisonment always up to 5 years plus fine. So this is about the imprisonment table. Now when there will be arrest, remember arrest will be applicable in case of only 3 offences. So there is ICE bid which comes under imprisonment. So just because there is imprisonment, it does not mean there is arrest. So because the person will be taken into the custody, that is known as arrest. After the person is taken into custody, he will be produced before the magistrate, and the magistrate or court will be passing the imprisonment order. So there is a difference between arrest and imprisonment. A person can be imprisoned even without the arrest, but arrest means a person is taken into the custody, that is known as arrest. Okay, so what are the non-bailable offences? So the non-bailable offences and arrest provisions we are discussing together. So remember IIC. So what is the third aspect we are discussing? First aspect we have seen what are the offences that leads to penalties, and the second aspect that we have seen is what are the offences that leads to imprisonment. Now the third aspect we are discussing what are the offences which are leading to arrest. So IIC, what is that IIC? Invoice default, ITC default, and collected an amount as tax and not paid within 3 months. IIC. In the case of this IIC, suppose if the amount exceeds 2 crores, then only arrest will be there. So if it exceeds 2 crores, then only arrest will be there. Otherwise, there is no arrest. Okay. Again, so there is something called as cognizable and non-cognizable. Cognizable means a person can be arrested without a warrant, that is known as cognizable. Non-cognizable means a person can be arrested so with warrant, that is non-cognizable. Cognizable means without warrant also we can arrest the person. Non-cognizable means warrant is required. Okay, and all offences which are cognizable or non-bailable offences means the person who is arrested should be produced before the magistrate and he cannot be released on bail, whereas non-cognizable offences are bailable offences. Warrant is required to arrest and those arresting officer can grant the bail. So therefore always remember NC plus B and C plus NB, non-cognizable plus bailable and cognizable plus non-bailable. Okay, so now what are the offences which are cognizable? Cognizable are severe offences. So this IIC greater than 5 crores is cognizable plus non-bailable, and arrest can be made. Of course arrest can be made once it crosses 2 crores, and inform the ground of arrest and produce before the magistrate within 24 hours. Okay. Whereas, what is the imprisonment? As the amount exceeds 5 crore, definitely the imprisonment will be up to 5 years and fine, minimum 6 months. Whereas, if the amount exceeds 2 crore but does not exceed 5 crore, it is non-cognizable plus bailable, arrest can be made and ACDC can give the bail. So, bail can be given. Suppose if the person who is arrested is not submitting any bail application, then in that case, then forwarded to the custody of the magistrate, and as the amount exceeds 2 crores, the imprisonment will be up to 3 years and fine. What about other offences? In case of other offences, there is no arrest. So, arrest will not be there, arrest cannot be made, and all these are called as non-cognizable and bailable, but that is something called as stupidity, because in law they gave it like that. So, once arrest is not there, when arrest itself is not there, what is the need of calling it as bailable, non-bailable and all? So, but in exam also you need to write this, no other go. Okay. So, logically if arrest is not there, so bailability does not arise, but in the law it is given that when arrest cannot be made, those offences are called as non-cognizable plus bailable. So, that is a drafting error which is made in the law. So, when we interpret two different sections, we will be getting like this. So, non-cognizable plus bailable, okay, and all other offences. So, arrest cannot be made. So, what are the offences that leads to arrest? IIC, invoice default, ITC default, collect amount as tax not paid within 3 months. If it is greater than 2 crores, arrest can be made, and if it is exceeding 2 crores but does not exceed 5 crores, it is non-cognizable plus bailable. If it exceeds 5 crores, it is cognizable plus non-bailable. So, then the last area that we are going to see is offences and that lead to compounding of offences. So, what is this compounding of offences? Compounding means granting immunity from prosecution. So, whenever there is an imprisonment, the imprisonment order will be passed by the court, and thereafter, before passing the imprisonment order, so we can request the officer to grant immunity from prosecution, so that the officer will withdraw the case from the court, and so that there won't be any imprisonment that will be passed. But the moment imprisonment order is passed, the case cannot be withdrawn, so we cannot get the compounding of offences. So, basically compounding means granting immunity from prosecution upon payment of a compounding fee by the offending person. And what is that compounding fee? That compounding fee will be ranging between 25% to 100% of the tax involved. Okay. So, 25% to 100% of the tax involved. So, that will be the compounding fee, and this compounding fee is as prescribed by the officer, and that will be ranging between 25% of the tax involved to 100% of the tax involved in this. In addition to this compounding fee, such person should pay tax, interest and applicable penalties also. So, anyhow tax, interest, penalty is payable, apart from that compounding fee is also payable, and there is restriction on first time compounding. So, what are the cases? Number 1, invoice without supply. Invoice without supply, first time itself you cannot go for compounding. Invoice without supply, not at all possible. First time compounding not possible. But sir, supply without invoice, yes, supply without invoice compounding is possible, but invoice without supply not possible, because that is regarded as a severe offence, and that's what I told you. Even in imprisonment also, invoice without supply is regarded as severe offence. That's why more than 1 crore itself there is an imprisonment up to 1 year plus fine. And then prosecution order is passed. That also I told you, once the prosecution order is passed, once the imprisonment order is passed, and thereafter they cannot grant any immunity from prosecution. And restriction on subsequent compounding, all these offences are compounding subsequently not possible, which means that compounding can be given to a person only one time during his lifetime. So, only once during his lifetime he will get the compounding of offences. Subsequent compounding is not at all possible in respect of any offence. First time compounding itself is not possible with respect to invoice without supply or prosecution order is passed. And some special points in this regard: compounding is possible if prosecution is not initiated or during the prosecution also, but the prosecution order should not be completed. Okay. After initiation of prosecution, say already in the court the case is there, and during the time also we can pay the compounding fee, and upon payment of the compounding fee all proceedings stands abated, means the officer who filed the case will withdraw the case upon collection of this compounding fee. So, that is about compounding of offences under section 138. So, these are the provisions that we have, and related to this compounding of offences there are some additional amendments also which I have given at the end of the That's It book. You can see that. So, we have some additional provisions relating to compounding fee. So, for compounding fee they have notified so little extra amounts like 25% to 100%. In that 25 to 100 is a bigger region. So, in that they have created some provisions. So, you can see here compounding fee notified for various offences. So what are the offences that leads to compounding? First, imprisonment we will see. If you see imprisonment, that is ICE bid, okay. So in case of invoice default, that to which default? Supply without invoice or invoice without supply? Invoice without supply is not at all possible for compounding. So therefore only supply without invoice, okay. So then ITC default, then collected an amount as tax, and then erroneous refund, IICE. Okay, in these four cases, that is definitely invoice without supply not possible for first time compounding itself. So supply without invoice, and then next in ITC default, collected amount as tax not paid within 3 months, and erroneous refund. In this case, what is that they are telling? If the amount involved in the offence exceeds 2 crores, then up to 60% of the amount of tax evaded or ITC wrongly availed or refund, or 40% of such amount, okay, whichever is higher. So for example, up to 60%. So department took 30%. So 30 or 40, whichever is higher, 40. Okay. Suppose if the department has taken 50. So 50 or 40, whichever is higher. So 50. So which means you just remember the range. What is the range? 40% to 60%. 40% to 60%. So 40% to 60%, any amount can be fixed by the officer. Actually, the general provision says 25 to 100. In that 25 to 100, in case of these offences, 40 to 60, if the amount is exceeding 2 crores, because exceeding 2 crores only there is imprisonment. Exceeding 1 crore, there is imprisonment only in one case, that is in invoice without supply, and that is not possible for compounding. Then suppose if it exceeds 5 crores, then it will be 50 to 75%. So 50% to 75%, 50% to 75% will be taken in this case. Then books of accounts default and dealing in goods liable for confiscation. So in these two cases, okay, so BD, books of accounts default and dealing in goods liable for confiscation, always it will be 25% of the tax involved. Then attempt to commit or abetting commission, so then also it will be the same 25%. So easily you can remember. So what is that? So there is ICE bid. In that ICE bid, for B and D, what is that? Books of accounts default and dealing in goods liable for confiscation, 25%, whatever may be the amount, more than 2 crores or more than 5 crores, 25% of the tax involved will be taken as a compounding fee. In other cases, in the remaining offences, wherever compounding is possible, so if it is exceeding 2 crores, then it will be 40 to 60%. If it exceeds 5 crores, 50 to 75% will be taken. However, where the offence committed by the person falls under more than one category, say for example, he is doing ITC default as well as books of accounts default, then in that case what will be taken? So then the compounding amount shall be the amount determined for which higher compounding amount has been prescribed. So therefore you go by with the higher compounding amount. What is that? 50 to 75 or 40 to 60 only will be taken. So this 25% will not be applicable, means along with this IICE and BD also is there. So then whatever compounding fee for IICE, that will only be taken, this BD related compounding fee will not be taken. That is what they have given. So this is one amendment related to compounding of offences. So we have completed. So offences and penalties, search and seizure. So then the next area that you can see, segment 19. Segment 19, demand and recovery under GST. So basically demand and recovery will be applicable. So there are two sections, two important sections, 73 and 74. Apart from that, other sections are also there, but 73, 74 are repeatedly asked the sections. So 73, 74 demand and recovery will be applicable in 5 situations. There is non-payment of GST, that is you are not have paid any GST, or short payment of GST. You have to pay some GST but you paid lesser amount, or wrong availment of ITC. So basically just we have availed the ITC but we have not reversed. For the purpose of making us to reverse also they can do that. That is the meaning of wrong availment or wrong utilization. So you have wrongly availed the ITC and you have utilized that, so for payment. So basically this wrong availment or wrong utilization should be understood as wrong availment and wrong utilization, because mere availment will not have any offence. So availment and utilization for payment of our liability or erroneous refund. So these are the cases for which 73, 74 will be applicable. So a show cause notice will be given. And what is the reason for that? So it can be on account of fraud, collusion, willful misstatement, suppression of facts, or contravention of provisions with an intent to evade payment of tax. So fraud, collusion, willful misstatement, suppression of facts, or contravention with an intent to evade. So there is an intention to evade that should be present, then 74 will be applicable. If there is no intention to evade, that is only error. So means there is no intention to evade, so 73 will be applicable. What is the time limit for issuance of show cause notice? So the show cause notice to be given, first order time limit we will see. In case of 73, the order should be passed within 3 years from the due date of furnishing annual return for a particular financial year. For example, if the financial year is 2023-24, for the financial year 2023-24, the due date of filing annual return is 31st December 2024. From 31st December 2024, the order should be given within 3 years. So within 3 years, the order should be passed if it is under section 73. So order under section 73. So that should be by, what is the date? 31/12/2024 na. So 25, 26, 27. So 31/12/2027 is the time limit by which order should be passed under section 73. And what is the time limit within which the notice to be given? From the order time, there is a notice that should be given at least 3 months before. Okay. So notice under section 73. So notice under section 73 should be given max by, so 39/2027. So between this notice and the order, there should be a minimum gap of 3 months. So this we need to maintain. So if this is the financial year for which the order needs to be passed, the order should be passed by 31st December 2027 and a notice to be given on or before 39/2027. So this is how we need to understand if it is 73. Suppose if it is 74, so then what will happen? Same financial year 2023-24, if this is the financial year, and then for this financial year, what is the due date of filing annual return? 31st December 2024, and from there within 5 years the order should be passed. So order should be passed within 5 years. So which means 31st December 2024, 25, 26, 27, 28, 29. So by 31st December 2029, the order should be passed. Order under section 74 should be passed by 31st December 2029, and the notice should be given at least 6 months before. So therefore, from the order date to the notice date, there should be a minimum gap of 6 months that needs to be maintained. So therefore, the notice, show cause notice or notice should be given by 36/2029. So this is notice under section 74 should be given by 36/2029, because there should be a minimum gap of 6 months. So this is in case of 73 and 74, time limit for order and time limit for notice. But remember, it is on account of non-payment, short payment or wrong availment and utilization of ITC. But in case of erroneous refund, this 3 years or 5 years will be counted from the date of refund. Okay, so it is not from the due date of filing annual return, it is from the date of refund. You can see here, time limit for passing order 5 years from the due date of filing annual return for relevant financial year, whereas in case of erroneous refund, 5 years from the date of refund. And wherever 5 years comes for 74, in case of 73 it will be 3 years, and a notice in case of 73 there should be at least 3 months before. So the gap of 3 months should be maintained, whereas in case of 74 at least a gap of 6 months should be maintained. Whether a supplementary notice can be given? Yes, both in case of 73 and 74 supplementary notice can be given. Supplementary notice is for the purpose of giving a additional annexure to the regular notice, so that for these years, like for example, already for one particular financial year notice has been given, for a subsequent financial year also the same mistake is committed, same grounds. Okay, it should not be different grounds. So same mistake is committed, then rather than giving a new notice for the subsequent year, for the notice which was already given for the previous year, an annexure will be given, so that for these two periods, for these two financial years, a single order can be passed. So that is the objective. So the same grounds, if it is same grounds, a supplementary notice can be given. And what should be the amount mentioned in the order? The amount mentioned in the order is TIP, tax, interest and penalty. And what is a penalty? 122 subsection 2 penalty. So in case of 73, the penalty will be 10,000 rupees or 10% of the tax or ITC or refund, whichever is higher. Whereas in case of 74, it will be 10,000 rupees or tax or ITC or refund, whichever is, or 10,000, whichever is higher. So 100% of tax, here it is 10% of tax, that's the difference. And this penalty under 120 subsection 2. And here we have some discount with respect to payment of penalty. What is the discount? Suppose if it is 73 penalty you take, so this is the penalty. But if you pay this penalty before show cause notice, then in that case you don't have to pay any penalty. Suppose if you pay this like tax and interest, if you pay the tax and interest before show cause notice, then penalty is not payable. So completely it is waived off. If you pay the tax and interest within 30 days after show cause notice also, so within 30 days after show cause notice also, you don't have to pay the penalty. Suppose if you make the payment beyond 30 days from the show cause notice, you need to pay the regular penalty. So tax, interest and the regular penalty, whatever is the regular penalty, that will be payable. So this is in case of 73. Whereas in case of 74, if you pay the tax and interest before show cause notice, you need to pay 15% of the original penalty. If the original penalty is 1 lakh, 1 lakh into 15%, 15,000 you need to pay. So the remaining 85,000 will be waived off. Suppose if it is paid after show cause notice but before order, so notice is given but before order, if you are making the payment, so then you need to pay, that is within 30 days. Within 30 days from show cause notice, if you are making the payment, so tax you need to pay, interest also you need to pay, but penalty 25%. For example, 1 lakh means 25,000 you need to pay and remaining 75,000 will be waived off. Suppose if you miss that also, and thereafter within 30 days from the order, if you are making the payment, so tax you need to pay, interest you need to pay, and the penalty will be 50% of the total penalty. So 1 lakh is the total penalty, means 50%, that is 50,000 you need to pay, and remaining 50% will be waived off. Suppose beyond 30 days from the order, if you are making payment, you need to pay tax, interest and the regular penalty, whatever is the regular penalty, that will be payable. So you need to remember this timeline so that the question can be framed based on this. And then there is one more order called as 76 order. So this is 73 and 74 order, whereas 76 order is there. Remember, 76 order will come into the picture only when amount is collected as tax. By representing as tax, we are collecting some amount. So not just the tax collected. Okay. So amount collected as tax. Amount collected as tax but not paid, then only 76 will be applicable. And there is no time limit for giving the show cause notice. Notice can be given anytime, even after 3 years, 4 years, 5 years, 10 years also, notice can be given. But whenever the notice is given, from the date within 1 year, the order should be passed. But there is a time limit for giving the order and notice in case of 73, 74. But in case of 76, the advantage for the department is that there is no time limit for giving notice. Even after 30 years or 40 years also, they can give the notice. And whenever they give the notice, from there within 1 year, they need to pass the order. And this is amount collected as tax and not paid within 3 months. So therefore, the penalty will be 100% of tax or 10,000, whichever is higher, 120 subsection 1. And here one more important point is that interest. Usually interest will be computed from the first date after due date till the actual date of payment. But in this case, the interest will be computed from the date of collection. So whenever it is collected till the date of payment. So for that period, for example, so somewhere 15th March it is collected. So from 15th March till the date you are depositing that money with the government, so the interest will be computed. And whatever money that is deposited with the government, so it will be transferred to the person who borne the incidence of the tax. So who borne the incidence of the tax? We unnecessarily collected GST from one customer now, so to that person it will be paid. Suppose if they are unable to identify that person, so then the amount will be transferred to consumer welfare fund. That is this. And then what is the time limit? So there are 3 orders: 73 order, 74 order and 76 order. Once the order is passed, what is the time limit within which we need to make the payment as per the order? That is tax, interest and penalty, whatever it is. So within 3 months from the date of the order, we need to make the payment of tax, interest and penalty. So or we need to go for appeal. If we are neither going for appeal nor we are making the payment as per the order, so then the recovery will be initiated as per section 78 within 3 months from the date of order. Otherwise recovery shall be initiated as per section 78. Or we can go for appeal also. When we go for appeal also, we will pay the pre-deposit. So when we pay the pre-deposit, the recovery will not be made. Okay, so that's what within 3 months either we need to pay or we need to go for appeal. Then is there any installment facility available? Yes, there is a maximum installment of 24 months that is available. So under section 80, so whatever is the amount as per the order, we can request for payment by installment, but it is not no cost installment. So means there is the total amount that we need to pay as per the order will be principal, and thereafter when they give EMIs, so there will be interest on that. So maximum 24 EMIs they can be giving. Then there is one amendment here, that is whenever you make the payment, so before the order date or before the notice, as the case may be, so you need to intimate them. So where a person makes payment of the amount under 73(8) or 74(8) or 129(1) shall intimate the proper officer of such payment. So we need to intimate that we have made the payment under DRC 3. Proper officer shall issue intimation instead of order in DRC 5 concluding the proceeding. So this step we need to do, otherwise they will pass the order and recovery also may get attracted. Then other provisions. So we have section 75. So 75 talks about the general provisions relating to determination of tax as per the order. So in that already 3 orders we have seen, 73, 74 and 76. Stay granted by the court or GST for a particular issue, the stay has been granted by the court or GST. So during that period they cannot pass the order. So therefore the time limit of 3 years and 5 years will be extended for further period. 3 years, 5 years and 1 year will be 1 year in case of 76 can be extended for a further period. Say for example, stay granted for 6 months, usual time limit 3 years. Now it will be 3 years 6 months, 5 years 6 months, 1 year 6 months, like that we need to take. Okay, such period shall be excluded from the date of notice or order due date. Then next, notice issued under section 74 not sustainable in the court. So they have given a notice under 74 invoking fraud, but in the court we went and we said that there is no fraud involved in this case. Now in that case the same notice will be converted into 73 notice. When the same notice is converted into 73 notice, then whatever amount that they can recover as per 73, that only can be recovered. Suppose if that notice is given, that is notice which is under 74. So they have given a notice under 74 which is not sustainable in the court of law, and that notice under 74 is given within the time limit under 73. What is the time limit under 73? So that is 2 years 9 months. How 2 years 9 months? 3 years minus 3 months, 2 years 9 months from the due date of annual return. Then whatever notice given under 74 is within the time limit under 73. So can the recovery be made? Yes, that amount can be recovered. So using that notice itself. Suppose the notice is given under 74 is not within the time limit under 73. So beyond 2 years and 9 months from the due date of annual return, then the recovery cannot be made as per the amount in that notice. So means the same 74 notice can be treated as 73 notice, and if it is within the time limit, the recovery can be made. Okay, and then one more point. So whenever the matter is remanded back for fresh adjudication, that is we went to the court stating that it is not fraud, and the court is telling yes it is not fraud, and the matter will be remanded back for fresh adjudication for redetermination. So why redetermination? If the notice is given within the time limit, 74 notice given within the time limit of 73, the redetermination may be made. That redetermination period should be taken as what? So after redetermination, from the date the matter is remanded back for fresh adjudication, within 2 years the tax should be redetermined and the order should be passed under 75. When the matter remanded back for fresh adjudication by the court or GST, demand order shall be passed within 2 years from the date of communication of directions. And then suppose if the notice is given for multiple financial years under 74, now with respect to those financial years for which the time limit under 73 is fulfilled, that amount only can be recovered. Say last 5 years, to recover last 5 years tax amount, they gave a notice under 74, but as per 73 we can recover the tax only for last 3 years. So the 3 years amount only can be recovered. So if the charges of fraud is not proved, if the notice was issued under 74 for multiple financial years and such demand order is not sustainable in the court, then with respect to those financial years for which the time limit under 73 is satisfied, redetermination can be made and order passed under section 75. Then proper officer shall grant adjournment for maximum of 3 times. So 3 times is the maximum adjournment that is possible, and interest is payable. Say in the order they have not specified that we need to pay the interest. Interest is a statutory liability. Whether it is mentioned in the order or not mentioned in the order, we need to make the payment of interest. And then amount mentioned in the order should not exceed the amount in the notice. If the notice is given for 10 lakhs, we cannot pass the order for 20 lakhs. So order can be for less than or equals to 10 lakhs only. So amount in the order cannot exceed the amount in the notice. Sir, penalty not specified in the order. So whether it is payable? No. Interest only, even if not specified in the order, we need to pay, but penalty only if specified in the order we need to pay, otherwise we are not required to pay. Then in case of self-assessed tax, what is called as self-assessed tax? Self-assessed tax means, so which is reported in GSTR 1 but not paid in GSTR 3B, that is known as self-assessed tax. So then in that case we have rule 88C. And which says that they will be giving an intimation and they will do the recovery. So due to that reason, direct recovery is there. There is no separate notice. So you refer to 88C. So with respect to this, you can refer to rule 88C. So as per rule 88C, what does it say? An intimation will be given, and thereafter, if you are not making the payment, so direct recovery will be made. That direct recovery is in terms of section 79. Then suppose if there is a similar issue which is pending in the High Court or tribunal, so till the time the judgment is coming, during that time order cannot be passed. So for that issue, so that period also will be excluded. Suppose 3 months the order is pending, like the issue is pending in the court of law, so order cannot be passed. So therefore the order time limit will be extended by 3 months. Similar issue pending in some other proceedings in GST or High Court or Supreme Court, such period shall be excluded from the due date of the order. Then these provisions are given in 75. So then 76 we have seen, and 77 tax wrongfully collected and paid. So treating intrastate as interstate and vice versa, we have made the payment. So we can pay the correct tax and get the refund. So we have discussed these refund provisions in refund segment, and what we are trying to understand here is that there is no interest and penalty. So just you pay the correct tax and get the refund of the wrong tax. Then 79 talks about direct recovery and what are the provisions for recovery. So recovery of tax, and here recovery of tax, so they have given various options for recovery of tax. So first what they will do, first they will deduct from any money owed from the government. So this is known as withholding of refund. Suppose we are required to get some refund from the government, from that refund they will be withholding that amount, that is known as deduction from any amount owed from the government. And sale of goods under the control of proper officer. Suppose if goods are seized by the proper officer, he will sell off those goods by way of auction, and whatever money realized, that will be adjusted towards the tax dues. Garnishee proceedings, that is recovery from a third person. So from the bank account or from the tenant or from the debtor, etc., they will try to recover the money. And sale of movable or immovable property, attachment proceedings. So they will attach the property and they will sell it off. As arrears of land revenue by the collector. So collector, how they will recover the arrears of land revenue? By making an announcement, etc., in that locality like that. Or as fine imposed by the magistrate. So magistrate fine, if it is not able to be paid, so arrest will be made. So that, and or through surety. So these are the various modes of recovery. And there is one point you should know, that penalty for self-assessed tax not recovered to 73. See, basically self-assessed tax they can do direct recovery under 79. Suppose if they invoke direct recovery under 79, what will be the penalty? There is a circular which says that the penalty will be up to 25,000, general penalty will be applicable. Suppose if they invoke 73, so in that case the penalty will be as per 73. So penalty for self-assessed tax not recovered to 73, not recovered through 73 is up to 25,000. As per CBIC circular. Then section 81. Section 81 talks about transfer of property to be void in some cases. Any amount has become due from a person, that is order has been passed. After the order has been passed, he creates a charge or transfer the property. So he tries to mortgage the property, pledge the property, or he tries to transfer that property to some other person. So that mortgage or pledge or transfer will be void. So that will not be considered as valid in favor of any other person with the intention of defrauding the government revenue. Such charge or transfer shall be void. Suppose if the charge or transfer is for an adequate consideration and the person who is purchasing it has purchased it in good faith and without any notice of pendency of the proceedings, then that transfer will be considered as valid. Okay, such charge or transfer shall not be void if it is made for adequate consideration in good faith and without notice of pendency of the proceedings under this act. Or suppose if the person has got the order and he is telling to the officer that, sir, I need to sell this property, then only I can pay the dues. So or with the previous permission of the proper officer. And tax to be first charge on the property. What does it mean? Tax to be first charge on the property means same as otherwise provided in IBC. So that is usually IBC law will prevail, like insolvency and bankruptcy code will prevail. Apart from that, suppose if there is any company which is going to liquidation, etc. and all, so whenever they realize the asset, the first payment will be paid towards that statutory dues. In that statutory dues, so indirect tax, GST is also a statutory due. And then provisional attachment to protect the revenue. Basically, in section 81, only when the amount has become due from a person, thereafter if he transfers, that is void. Suppose if the notice is given and the order is not yet passed, during that period if he transfers any asset, so that is not void now. So then if he transfers, then what is the relief available to the department? That's where 83 will come. Provisional attachment to protect the interest of the revenue. So that is whenever proceedings are started. So whenever there is a proceeding, that is notice or any proceeding that has started, and the department is having a doubt that he can transfer the asset, so department will attach the property, so provisionally. So they will pass an order for provisional attachment, but that provisional attachment will be maximum for a period of 1 year. Means within 1 year they need to complete the proceedings and pass the order. After order, anyhow if we transfer, that will be like void. So provisional attachment of property including bank account after initiation of any proceedings under assessment or inspection, search, seizure, arrest or demand and recovery for a period of 1 year from the date of order of provisional attachment. Okay, and there is one amendment in this case. Rule 159 says that suppose if they attach any immobile like any cars or motor vehicles, etc., then the revenue or any property, the revenue authority or transport authority or such authority who has placed encumbrance on the movable or immovable property on the order of the commissioner shall remove such encumbrance on the written instruction from the commissioner to the effect or expiry of the period of 1 year. That is provisional attachment. The moment provisional attachment is passed on that asset, there will be an encumbrance. So which means that, so we cannot make the sale. So due to that reason, the moment 1 year is over, the provisional attachment order ceased to exist now. So then the officer should release that encumbrance on the property. That is this. Then section 84, continuation and validation of certain recovery proceedings. What does it say? Suppose if they have passed an order and on that order we went for an appeal. Order is for 5 lakhs and we went for appeal, and appellate authority enhanced it to 7 lakhs. So generally appellate authority cannot enhance it to more than amount in the order. So 5 lakhs, if they want to enhance it to 7 lakhs, for that extra 2 lakhs, they should give us an opportunity of being heard. But the appellate authority cannot give the notice. The commissioner will be directed to give the notice for that excess amount. Commissioner shall serve a notice for such excess amount, and appeal order shall be passed on such enhanced amount without adjudication order for the excess amount. Okay. So therefore, appeal order will be passed for that enhanced amount 7 lakhs. There won't be any adjudication order, just the commissioner will give a notice for the 2 lakh rupees. Okay. So that is this, without adjudication order for excess amount. And other proceedings means any proceedings, it can be under IBC also. And next there is a CBIC circular related to difference between 122(1) and 122 subsection 2. So 3 situations are given. Clarification number 1. So Mr. Amar, so I just converted that into example for understanding. Mr. Amar is a supplier, Mr. Balaji is recipient. Amar is raising invoice on Balaji. Okay, without supply of goods, just the invoice without supply of goods. There is no supply of goods, which means Amar is not having a liability first of all, because he just raised the invoice and there is no supply, means there is no liability on Amar. When there is no liability on Amar, recovery under 73-74 cannot be initiated on Amar. So due to that reason, the penalty will be under 122 subsection 1, as there is no 73-74. Demand and recovery under 73-74 cannot be initiated because there is no liability. Consequently, penalty under 122 subsection 1, invoice default. Okay. Then clarification 2. Now what about Mr. Balaji? Based on the invoice which is given by Amar, there is no supply of goods. Balaji availed the ITZ and he set off with his liability. Because he set off with his liability has come down, means there is, like, suppose if this fake ITZ is not taken, his liability he would have paid. For example, 10 lakhs is a liability and the fake ITZ is 2 lakhs. So instead of paying 10 lakhs, he will pay 8 lakhs. So then 2 lakhs is a short payment of tax. Now he need to pay the 2 lakhs. So as he is required to pay the 2 lakhs, they will be doing demand and recovery because ITZ availed and utilized for payment of liability. So he need to pay that. Because of this, there is a short payment of tax. So the demand and recovery will be initiated on Mr. Balaji. As demand and recovery initiated on Mr. Balaji under 73-74, so he has done a ITC default also, but penalty under 122 subsection 1 will not be applicable in that case. So penalty not leviable under 122 subsection 1 as 73-74 is initiated, okay, on Mr. Balaji. Then see the clarification 3. Mr. Amar is raising invoice without supply to Mr. Balaji. First of all, Amar is not having any liability. Due to that reason, no recovery under 73-74, but penalty under 122 subsection 1, that is invoice default. Then what Mr. Balaji did, he also raised invoice to Mr. Charan and without making supply, means he got a fake ITZ and he made a fake liability. Liability also not real, ITZ also not real. So therefore, there is no recovery on Mr. Balaji because the liability what he has is not a real liability, and the ITZ what he has taken is also not the correct ITZ. So in that case, there is no liability on Mr. Balaji to pay to government, but he committed 2 offences. What are the 2 offences? Invoice default and ITZ default. So for the 2 times he need to pay the penalty. So 2 times penalty is payable, one for invoice default, one for ITZ default. Now what Mr. Charan has done, he took the ITC and he set off with his regular liability. So because of that, there is a short payment of tax. So there is a demand and recovery on Charan because he need to make the payment of tax. As he is required to pay the tax, Charan is required to pay the tax. So due to that reason, there won't be any recovery from Charan or not. There is a recovery under from Charan. So due to that reason, 73-74 applicable. So 122 subsection 1 ITC default will not be applicable in that case. So that's where from these 3 examples, what you can remember is that, so section 122 subsection 1 and 122 subsection 2 are mutually exclusive. So that is about this demand and recovery. So the remaining portions in GST, so we have 3 small areas: appeals and revision, advanced ruling and ethics and other provisions, plus so the customs part we will see in the next lecture.